Hey everyone, Meet Kevin here. Welcome back to another Meet Kevin show. Today, well, in this episode, we are talking to Jeremy from Financial Education 1, 2, and 3. Because this guy's a beast with 3 channels on YouTube. So much freaking value. I love Jeremy. I've met Jeremy in Vegas many times. He has made me want to move to Vegas so badly. But this video is not about moving to Vegas because I could talk to you about that for hours. Instead, we want to talk about the market crash, inflation, Tesla, Bitcoin, investing. What is 2021 going to look like? And to help me figure that out, here's Jeremy. Welcome aboard.
Hey Kevin, first off, man, thanks so much for that intro. That was amazing, and thanks for having me today. This is amazing, man. I'm looking so forward to this.
Oh, thank you so much for being here. Well, by popular request, the most frequented question that people are asking me to ask you about is, what's going on with the money printer? We got Jerome Powell cranking this thing faster than our arms can even move to mock this guy, okay? The money is flowing so much. What's going to happen, man?
Yeah, it does scare me. I'll be honest. When the printing slows down and this money sloshing slows down, it does scare me a bit. I'm watching so many different things happen. This is such a deep subject. I'm watching so many different things happen at once. So one, I'm watching, obviously a lot of stocks get to overvalued valuations, right? We're watching that happen. Simultaneously, we're watching real estate just booming right now. And I mean, absolutely booming. Like out here in Vegas, I've never seen it like it is out here in Vegas right now. I mean, properties are moving that, you wouldn't have thought they would have moved a year ago. And they are just moving left and right, or 2 years ago. Raw pieces of land are moving like left and right now. And so I'm watching real estate consistently move up. The Arizona house, we got a house in Arizona. We're like, if we were allowed to sell that, you're not allowed to sell for a year, we would already be in the green at least 150K on that. The Vegas house, from the time we move in there, will be in the green at least $250,000. So I'm watching stocks and real estate just go crazy. Having conversations. I was having a conversation with a friend the other day. He has a ductwork business, and he was telling me about steel prices and aluminum prices have been going crazy, and they're having to do like surcharges of customers. And I'm just watching all this kind of play out, and I'm like, we are just in a situation where the dollar is definitely becoming worth less, and everything else is pretty much getting more expensive. And it's an interesting time, needless to say. So
Yeah. So do you think this is because, I mean, people have so much more wealth now that maybe their portfolios have gone up in the stock market, their real estate ownership values have gone up, that they have more money to spend on things, and that's creating more of this demand on, like you say, ducts and lands and other real estate. It's almost like this self-perpetuating cycle of more money, more demand, more money, more demand. Is it sustainable? Like when does this just slow down and level out, as they said in 2007, 2006 and 7, that no worries, this is just leveling out? What do you think?
yeah, I think eventually things are going to calm down a bit. I think, obviously this is all this talk about the $1.9 trillion plan, and that's a bunch more sloshing of money out there. So at some point, yeah, things have to calm down. Maybe it happens even this year I've kind of like been thinking about like summertime potentially as that time period to really watch and pay attention to and really like see what happens. But yeah, I think when assets continue to go up, it makes people, have either more FOMO or like they just have more money to invest in more things, right? I mean, you see stocks, you see cryptos, right? I mean, crypto market just goes up and up and up. Bitcoin's gone from, I think it was 3,000, I don't know, 40, 50,000 now, right? Real estate. And I think a lot of people are looking at it and they're like, why do I want to save money? What's the point of having, a bunch of money in a savings account when you just see those dollars getting worth less and you see everything else getting more expensive? It's like, why didn't I just use that money to buy an extra house? Who cares if I even rented? Let's just buy an extra house to buy an extra house. So
Yeah.
it's a weird time period, man.
That's interesting. What you just connected there is I was thinking, okay, if people have more wealth, they can demand more, but it's not just people having more wealth, but then it's also the FOMO factor of like, okay, well, now I have more wealth. Oh, damn, I should be using this better and I should be YOLOing more.
100%, 100%. And people are getting kind of pushed into some riskier assets. And I'm sure we'll talk about stocks in this video, but you know, even
Oh, yeah.
me, like I'm having to get pushed into, well, yeah, it's funny. I'm either getting pushed into much riskier assets or much safer assets. So I'm starting in the stock market now. I'm starting to look at either really small caps or actually like really large established value stocks now. And so it's an interesting time period, but whenever interest rates are this much of a joke and mortgage rates are this low and everything like that, it's going to push people to take more risks. Let's get another mortgage, let's rent another property, let's buy some more stocks, let's buy on margin. You know, so yeah, it's the time period we're in at the moment.
What are some of your large value plays that you're looking at? I mean, we hear, for example, Kathy Wood says, Google, Apple, great companies, but they're cash parks. We got to invest in things that are the next gen. How do you sort of balance out your investing thesis versus, somebody's popular now as Kathy Wood, who says something like that? And how do we compare tech to value these days?
Yeah, I mean that's a really deep subject. I feel like every person has to have some of those more stable plays, right?
Okay.
Right now we're in a time period where the tech stocks have been riding high. Growth stocks have been riding high. Everybody wants to be. We're in a risk-on environment, and those stocks are going to perform better than ever, right? But yeah, I mean, I'm looking at a lot of stocks I've been investing in over the past month or two, like Facebook, like Walgreens, WBA, like that one I put 7 figures into just in December, which I don't think I've ever put
Wow.
7 figures into a stock in 1 month ever in my life, other than this one particular situation. I was just like, this is too good of a deal. So yeah, I mean, I feel like you have to have some value plays. If you don't, you're setting yourself up for big risk, and especially with a lot of these stocks that are at somewhat nosebleed valuations. And right now we're in a market where no one's kind of focused on that. Everybody's focused on just the growth, as we said. But yeah, I think it's important to just kind of add a little diversity to these portfolios and think about some stocks that it's not just about the reward potential, it's about that risk. I always talk about risk reward, and it's some people aren't really even thinking about that. So
Is it possible that something like a Walgreens could be a value trap where maybe an Amazon comes in with, delivering medications and Walgreens becomes less important, where maybe the daily essentials are already a little pricier because they've got the
yeah.
pharmacy there. What's your take on the risks for a Walgreens?
Yeah, I think about that all the time. In terms
Mm.
of like, are some of these stocks value traps, whether it be Walgreens or Facebook or any of these different stocks. You have to kind of look at it on a case by case basis. So Walgreens is, the valuation's so darn low on it. Even after
Mm.
it's gone up from 40 to 50, it's still so darn low that it makes sense just to go up over time based upon the fact that they're going to be giving out the Rona shots. That's going to drive a lot of in-store traffic when they have a lot more customers in their stores. Those people end up buying more stuff. Like that's just the way the business model works. They're adding actual
Mhm.
clinics. They're going to have a ton of cash to kind of retrofit their business and get their business into something that's going to be relevant for the next decade or two. Curbside pickup,
Mm.
delivery, drive-through, all these sorts of things. I think they're in a strong position. And then they got a new CEO coming in who actually was a COO of Starbucks, was a CEO of Sam's Club unit, and then she's on the Amazon board of directors. And I think she's one of the only, if not the only, female CEO in the S&P 500. And I think there's going to be
Nice.
a lot of backing behind her in wanting to see that company succeed. So, and she's just very well connected. So, yeah, but I do think about that whenever I get into a value stock. I'm like, is this a value trap? And on the reverse, in a growth stock, I think, am I getting FOMO'd into this? It's something that should always cross your mind. Am I, with a growth stock, am I getting FOMO'd into this? And then value, am I getting into a value trap? It has to cross your mind every time.
Got it. So is Walgreens potentially like a shorter term recovery play, or are you in this one diamond hand long?
So I'm planning on it for like the next 3 years, like a
Okay.
3 year type hold, 3 to 5 years. But at the same time, it depends on how good the turnaround is. I mean, if we look at this business in 24 months from now, and it is just clicking on all cylinders, the numbers are amazing. It's more relevant and in a better place than it's been in many years. Then I could definitely hold longer term and just use it as a dividend
Mm.
cash flow stock, and just throw
Mhm.
off that dividend money to me and redeploy that into other stocks. But we'll take it. We'll take it year by year with that one. So
Is it? I mean, uh, somewhat, it kind of sounds a little similar to GameStop. You get the Chewy founder coming in, new vision. Let's try to turn around the model. Is it possibly similar to GameStop? Do you see maybe less risk in Walgreens than a turnaround over at GameStop?
Well, yeah, because Walgreens, they sell needs-based items. That's kind of where the difference comes in. I mean, when we talk
Nice.
about giving out the Rona shots, right? Like, that's
Yeah.
something people need. You talk about getting a bottle of Tylenol. It's needs based. Pharmaceuticals obviously is their main business driver. From the pharmacy game. So I feel like that's obviously very needs based. And not to say GameStop's the wrong stock or something like that. It's just like Walgreens. It's a really different business model. And I love if you're getting into a value stock. I love a value stock that's needs based, man. That's always a good business model. Because think about it, like even if, let's say, we have a true recession, which we had kind of a more fake recession recently, right? Let's say we have a true recession and the government's not there to help nearly as much, right? The needs-based business models are what thrive in that environment, and anything high growth, those ones get really, really devastated. And so that's another way I kind of look at it, as a place to park money, where just in case things went off the rails and the government's not there to save things as much as this past time. Because this past time, the excuse from the government was, well, we're in a once in 100-year, health event. We need to, put as much money out there as possible. It doesn't matter if it's 3 trillion or 5 trillion, like increase the balance sheet. Like, it doesn't matter. What happens if it's not because of that and we just have an actual true recession? I'm sure the government's going to be there at some point in time to help, but are they going to be there to that level where they can get away with just doing anything? I think those are some questions, fair questions.
This is interesting. I want to talk about this fake recession versus recession. So what makes you call it a fake recession? Is it because of the response the government took? Like, let's just print our way out of this and guarantee everything, so to speak, versus maybe is a true recession maybe like what we saw in 2008, where the financial sector actually fails? Like, you actually have banking failure, which we didn't.
Yeah, I definitely see a huge difference in them. Obviously this one, it was just throw anything out there, ask questions later, throw the money out there. And you can say that could be the right approach, right? Because who would have wanted to see a Great Depression scenario? Obviously,
right.
I'm sure, no one would have wanted to see that. So, but it was definitely, let's throw as much money out there as possible, ask questions later. And obviously it was too much. Let's be quite frank, because look at the way assets have gone. If you would have asked me when all this stuff was breaking, and we were shutting down the economy 11 months ago, right? You would have asked me, okay, in less than a year from now, the stock market will be at by far and away all-time highs. Real estate's going to be going crazy in most markets around the United States. I would have said, you're crazy. There's no way that's happening. And it happened.
Yeah.
So that's where it's like, this is definitely an artificially inflated, throw money out there any way possible. There's a lot of stuff going on the underbelly, where people have been doing kind of like fraud and different things like that, as far as like getting money. The PPP loans, like people that shouldn't have probably been getting them. Unemployment, like a lot of people that maybe shouldn't have been getting it have been figuring out different ways around the system, because none of this stuff has been checked. So like, right, and we're talking about millions and millions of people. It didn't really feel like a real one. You can't have stock markets at all-time highs. You can't have real estate going crazy, and call it a real recession. That's not a real recession. Real recessions when it's sustained for at least a couple of years, and there's definitely that feeling of just, dang, man, it's rough out there. And so very, very different than what happened in 08, 09, 11. People coming out of the Great Recession were scared to invest for years and years and years.
Yeah.
And look at this scenario. It was buy everything in sight, right away. So it's so different, man. It's so different.
Do you see a real recession coming within the next 5 years?
I have no clue. I'll be honest. I have no clue.
Yeah.
It's really tough to say. It's so tough to say and forecast out that far, because I mean, it's just the world's too crazy, man. Too much crazy stuff can happen. Like if you would ask me 5 years ago, you see a once in 100-year health event happening and them shutting down the entire economy, I'd be like, well, I guess that's possible, but I don't know. Like, yeah, so it's too hard to say, man. It really is. But it is going to
Are
be
you
interesting.
repositioning just in case, or are you sort of repositioning? Are you getting more defensive because of what you're seeing? Or are you changing the way that you're investing?
Yeah, I'm getting a little more defensive as time is going on. Like you see the Walgreens move. I've been buying more Facebook stock. I've been buying some of these stocks that the valuations is pretty low, and it's not as much about the insane reward potential. And so, yeah, I have been positioning a little bit into, diversity, a little more away from the growth stocks. I bought a new stock recently that I haven't even told YouTube about. So anybody that gets to see this, Corsair Gaming. So I bought Corsair Gaming recently. I bought 60,000 of that. I think it was on Thursday I bought it. And Corsair Gaming it's a growing company, but it's not like some crazy growing company. You know what I mean? Like they should probably grow revenues, I would guess, between 10 and 20% this year. And those are the type of stocks I'm kind of looking at right now, where maybe it's not like the Tesla type stocks that I've been in the past years, where it's growing revenue 50% or something like that. So I am kind of a little more going toward a little more conservative moves. But on the flip side, I have been getting into some of these super high growth, super small caps too. So it's kind of like a balancing act, I guess you would say.
Well, yeah. I mean, you just said that you put over 7 figures into Walgreens, so over $1 million into Walgreens in December, and your new stock here, you put 60K in. How do you decide? Like, at what point do you get? Is it possible that potentially you get too spread out? You've got too many, or is it like I'm planting seeds, or how do you divvy up that?
Yeah, that's a really important question. So I try to always hold, like, if you look across all my different portfolios, I try to always hold like 20 stocks or less total, so I don't get
Okay.
too spread out, too thin, right? So that's usually kind of my game plan going in. And it's really about the risk reward. So if I feel I'm getting into a stock and the risk of that stock going down 50% over the next 3 years is extremely low, and the probability I double up my money or more in that stock over the next 3 years, if I feel like that's extremely high based upon all the study I've done and looking at the valuation, all those sorts of things, that's the heavier I go. And so in regards to like a WBA situation, I looked at that stock and I'm like, is this a stock that could really be $20 3 years from now? And I was just like, there's no way I can possibly see that. I'm like, I think it's less than a 1% probability. I'm like, could I see the stock at $80? And never mind, it's going to pay me out a bunch of dividends, which obviously increases my return. Yes,
Yeah.
I can definitely see that as being a pretty high probability. And so I look at a scenario like that and I'm like, okay, let's invest heavy and let's not wait around for this one. And the ones I'm a little less confident in, where it's like maybe a 10% probability, but a 90% probability upside, I'll still invest in them. It's just a little smaller. So
How much are you selling to move money around? I mean, are you ever get afraid of paying those capital gains taxes? That always makes me cringe, just capital gains.
yeah,
And maybe that's because I'm in California though.
yeah, no, 100%. Yeah, I don't sell that dang often, to be completely honest. Most of my stocks I keep around. Sometimes I'll move money. Like, let's say I have a stock that I just feel like the money's kind of already been made there. I'll move it out sometimes. But yeah, I don't like to sell, especially short-term gains, man. So the short-term gains are the worst. So I definitely don't like to sell, for anything I've held for less than a year. And I don't sell that often. To be completely honest, like, let's say I want to buy a position, I'll usually because I usually keep a lot of cash around. So like 7 figures plus I'll keep around in cash. And that doesn't mean actual physical cash for anybody that's confused. Like, that just means like money in checking accounts, savings accounts, money you can just get too easy. And so I always like to keep plenty of money around. And then when I see an opportunity, pounce, invest in it and kind of go from there. And then, I'll go through a time period where I won't buy that many stocks, or I'll buy very little amounts and I'll just kind of build cash. Build cash. Oh, there's an opportunity. Boom. So yeah, that's kind of
Are you trying to Is it like percentage based? Just to make that relate to maybe anybody watching. Is there a percentage of cash that you like to keep relative to your portfolio? Do you feel that's a safety net, or is it for opportunities, or both?
Yeah, I like to keep 10 to 30% always. And so the way I kind of look at that, just for anybody that's never heard me talk about 10 to 30% of your net worth in cash, or money you can get to easily in checking accounts, savings accounts, whatever. Essentially, how I think about that is, so if we're in a time period where there's deals all over the place, and it's what I call shooting fish in a barrel, and stocks are just disgusting deals. I like to get I'll get all the way down to about 10% cash. I never like to go under 10% cash, because then it's like, let's say you're all in the market. I mean, that's kind of hard to sleep at night, right? And then you're wishing that the market starts going up, and no one wants to be that guy that has no money to throw in the market, right? That's not a good feeling. So yeah, I'll get down to like 10% if it's one of those time periods where it's just a lot of deals. Now, if there aren't that many, I'll get up to like 30% cash. And I've done that in the past and got up to those sorts of levels. Right now, I'm probably about 22%, I would say, or 23%. But I never like to go over 30% cash, because there's risk in that. Because if you go 50% cash, 60% cash, and you watch all these assets continue to go up and up and up, and your dollars become worth less and less and less, there's actually a risk in that. So you have to take the risk on both sides. It's like, are you too heavily invested, or you're not quite enough? So so I've never gone over 30% anytime in my in recent years. I always pretty much actually, I don't know if I've ever gone over 30% at any point in my life, to be completely honest. And I've been investing a long time.
So, have you been in situations where you've gotten down to 10% recently, or are you having a harder time finding deals to where, maybe you're I don't know, 15, 20% cash now, because maybe you're not seeing as many deals?
Yeah, I'm not seeing as many deals, and that's why I'm over 20% right now. That's kind of usually a good barometer. Like when I get over 20, that means I'm leaning more toward the side of not as many good deals. And so right now, I think I'm at 22%, maybe 24%, somewhere in there. So I'm leaning a little more that way. But yeah, I mean, I'm sorry. Back to your question, it was about 10%, 30%. I'm trying to remember where I was going with that one.
Oh, yeah, I mean, just mostly, I think, the safety, and then really, if you have too much cash sitting around, then you have that risk as well of
Yeah.
maybe missing out on returns, huh?
Yeah, exactly. Yeah, that's where I was going with that one. Yeah, you get too high, man. It's like, with the cash levels, it's just, you start missing out on deals. And the way I kind of also look at it is, it kind of like pushes me to look into more stocks, because there's thousands of stocks in the stock market, right? And it's like, if I was to go over 30%, you're going to tell me there's not one deal in the entire stock market for me to put some money in. There's got to be one stock out of thousands and thousands of stocks that is a hidden gem in the rough that no one's really talking about or looking at, and is a deal right now. There's got to be that opportunity. So that really like pushes me, man, to like, hey, man, let's not go too heavy cash. Let's put it that way. So
At what point would you go into margin?
margin. I mean, if money hasn't cleared, sometimes I'll buy in margin.
Okay.
I'm not the biggest fan of margin, to be completely honest. Yeah, I'm definitely not the biggest fan of margin, but I mean, it depends on the situation. There are time periods where it's really attractive. I mean, the summer, I felt like, was a time when it could have made sense to go a little on margin, right? Because I felt like the summer was a time period where stocks were still pretty cheap, and it was clear like the recovery was happening. So like ideally, I mean, it would have made sense to go margin in March, right? When the market was at the bottom, but that was a scary time. I mean, I wish I would have been that smart to time it out and went all in at the bottom, but that was because, I mean, we were shutting off money velocity, and that was like, what have we ever done? But margin, I feel like, is not for most people, and not for most people that are, inexperienced in the market, because what ends up happening if you don't have the experience in the market, you a lot of times don't have a good capital. And so the margin rates you have to pay are substantial. I mean, the margin rates are insane. Sometimes you have to pay, if you don't have that much money, like, Fidelity, for instance, that's just one brokerage. I'm sure a lot of them, like, I think they charge like 6 or 8% interest rate if you have smaller amounts of money, like under 100K. And that's a lot of the people that are investing. So gosh, you got to get 6 to 8% of the market just to, pay, basically break even, right? Then obviously you have to make the gains in the stocks and things like that. And I'm just like, and the problem with a lot of newer investors, they margin at the worst time. So they margin when everything looks great. They margin when the market's already gone up like crazy, and they're more likely to FOMO. And and then they get way too heavy. They get margin calls. It ends up in an ugly situation. And I've been there. I went through that in 2015 when I was just margin out crazy and playing earnings trades and doing all types of. I went off the rails that year. But I definitely see there being a big risk to newer investors trying to get in on a margin. To be honest, I don't think
what happened there. I mean, this is pre-YouTube, right? So you got some margin run-ins.
Yeah, I mean, I had amazing gains. I was knocking it out of the ballpark. So I was getting like 30 to 40% like every year. I built up like 200K in stocks. And so then I left Quick Trip and I was like, okay, well, if I'm getting 30 to 40% almost every year and I've only been focusing on this part-time, I'm going to go full-time, start doing this, and I'm going to margin out another 200K or so. And so get my account up to 400K. And so, but what I started getting into, especially as I had more time on my hands and I wasn't working, wasn't doing anything, is I started doing earnings trades, where basically, because I can kind of know certain companies, if I know them well enough, I know if they're going to beat earnings or miss earnings. What I didn't realize back then was just because a company beats earnings does not mean the stock's going up. Like many times, a company will beat earnings, and it always happens to newer investors. They'll be like, "What? This company beat revenue? They beat EPS when this stock just went down 10%." And that would happen to me sometimes because either guidance wasn't right or just whatever happened. And and so I lost a lot of money that year. That was my worst year ever in the stock market. It's just a horrible situation essentially, and a lot of it was because I got into short-term trading. As far as around specifically trying to swing earnings, and then I got into margin and just started going heavier and heavier, and it exacerbated the losses. And if you're trying to go from 200 to $1 million overnight, the best way to do it is not trying to do it tomorrow. Let's just put it that way. So.
That's a good point. So, you've mentioned a few times here, Walgreens and dividends. Why? If you're, growing your portfolio, you're younger, why do you care about dividends at this point?
Well, so first off, like my overall investing approach is really an approach where you need to be good at, picking growth stocks. You need to be good at picking turnaround stocks. You need to be good at picking value stocks. So that's my, kind of like discipline. If you're an incomplete investor, if you're only good at one thing overall, because there's going to be time periods in the stock market where value stocks get incredibly overpriced. There's going to be, that's usually in a risk-off scenario. There's going to be time periods in the stock market where growth stocks are a complete ripoff. There's going to be time periods in the stock market where turnaround plays are a complete ripoff. All these different stock categories go through these highs and lows, right? If you are truly good at picking growth stocks, value stocks, dividend stocks, whatever you want to call it, all these different plays, like then you're opening up your whole stock market world, right? You're opening up to such a bigger amount of stocks. So, I think that's why, younger investors or even investors who might not have as much money should care about that. I cared about that when I didn't have much money and I was investing my first few $100s and my first few $1,000s in the market. Looking at it from a perspective of you're trying to get good at picking all these different stocks. You don't want to be one-dimensional, right? You don't want to be, I always give a sports analogy. Like imagine you're a boxer and all you can throw is a haymaker. That's great if it connects sometimes. And then a lot of times you're probably going to get knocked out because you don't know defense. You don't know this and that. And the same thing in the stock market. It's like, if you're going to be a truly great, well-rounded investor, you have to be good at all these different disciplines, I feel like. Otherwise, you're incomplete. And the guy I look up to more than anybody in the stock market is Warren Buffett. And that's the guy that I learned all my early game as far as value stocks and picking those type of stocks. If you're going to poke one thing at him, he's never been a growth stock investor. He's watched stock after stock pass him by, whether it be Apple. He got an Apple just a couple of years ago, but he watched Apple grow within the Steve Jobs era, just didn't invest in it. Amazon in the Jeff Bezos era, Google. He watched Facebook. He watched Tesla. He watched all these companies, NVIDIA, Shopify, pass him right by, never gotten any of them except for a couple of them very, very recently when they're already huge. And that's a whole. I mean, imagine how much money Buffett could have created for his shareholders if he was good at picking growth stocks as well. And so that's why I really look at it. I'm like, you have to be, good at all this stuff if you really want to be a great investor from 2020 to 2100. Let's just put it that way. So.
Well, yeah, no, I mean that's such a great great way to put it here. So why not, and I know Warren Buffett, he's got quotes like, I'll probably butcher it, but something to the effect of diversification is for basically people who don't do the research. I think like diversification is for like a safety net for ignorance, so to speak. And he's got this, the 20 punch card psychology where you pick your 20 stocks your whole life and then you ride these. That's it. You got 20 picks. You better pick the best ones, which you had mentioned 20 was sort of your number as well. I mean, isn't there some value to what he's saying, or should we just YOLO everything on Tesla in that sense?
Yeah, yeah, I don't know, because I mean, if you look at Buffett, his company and his portfolio is really diversified. Like, there's many times where he'll hold, sometimes I've seen him hold as much as like 43 stocks before. And obviously, if Berkshire Hathaway, they own so many different businesses. It's incredible, like from Fruit of the Loom to Dairy Queen. You know what I mean? So, I mean, he's extremely diversified, but yeah, I think it's about finding that right balance, right? And I mean, if you want to be a stock picker, I think keeping under 20 stocks is usually a pretty good number, relatively speaking. Okay. Because I mean, let's say you're going to invest in 200 stocks. At that point, why not just put the money in an index fund? You know what I mean? Like, right. At that point, you might as well let's just buy all the S&P 500 now. And at the same time, I did this in the past with the whole margin stuff that I got into, I would go, insanely heavy in 1, 2, 3 stocks. And that ultimately can really, really hurt you, because you're really riding all that. It's different from people look at like people that have had success in business and they say, well, that person made all their wealth from, whatever business they started. Well, the thing is with their business, they could control that, right? They could be there in the day-to-day operations. They can push through it. They can make moves, things like that. When you're just investing in the company, you can't help dictate that. You can't help do that. So that's a risk. And so it's about finding that magic number. And I always feel like, for most people, 5 to 20 stocks is the right number, just depending on, and the more money you get, kind of the more diversified you get. The less money you have, kind of the less diversified. Like there was a time period where I had 3 stocks. Then as I built up, I started having 5 stocks. Then as I built up, I started having 7, 8 stocks, then 10 stocks, 15 stocks. Now I'm probably around 20 stocks between all my portfolios.
Yeah. Oh, that makes a lot of sense. Yeah, I started out with Apple stock like 10 years ago or whatever. Like, I got $500.
Apple's a funny one because so many people were like, like I have a friend. He's like, man, I was standing in line to buy the first or the second iPhone to come out. He's like, why? That was so stupid. Why didn't I just worry about buying the stock instead of buying that first generation or second generation iPhone? I stood in line with all these different people and I didn't even think about buying the stock. Oh, man.
That's funny. I remember those days because I was one of those dudes standing in line, but I did buy the stock too.
Nice.
But then again, I was working on Jamba Juice income. So it's a little harder.
Hey, Jamba Juice, that was a hot stock a couple of years ago, man. I'm not sure if you played that one or not, but anyway.
I actually didn't even think about that. I should look at that. That's hilarious. Oh my gosh.
I don't think they're a public company anymore. I think they got bought out by somebody, but I think before that, it got to like penny stock territory, and then I don't know. I think it went on a crazy run.
Yeah, there was like a whole movement there for a period of time, like frozen yogurts and smoothies and things like that.
Yeah, 100%.
Wow. So what? Okay, so if somebody's starting out today, a lot of the conventional wisdom, and I don't know if this is just like overly generic, but I want to hear your comment on it. A lot of the conventional wisdom is, hey, just put your money into a Vanguard index fund and just forget about it. Just automatically continue to invest. Why do that, or why not do that?
Yeah, I think that's a good move if you don't feel like researching the companies. I think 100%. Like, put your money in S&P 500 index fund. You're going to grow your money over the next 15, 20, 25, 30 years. No doubt about that. I think that is the play if you don't want to do the research work. However, if you are somebody that really wants to put in the research work, you really want to try to outperform the stock market, like, it makes sense to, pick the stocks. I mean, the gains you can get are just so much more than anything you could ever have dreamed of just investing in an index fund or something like that. With that being said, I think you need the right strategy, though. I think you can't just if you don't know what you're doing and you haven't really learned from people that do this successfully and you haven't put in the work, I think you're setting yourself up for a bad situation as well, right? I mean, if you just go into it blind, it's not it's not a good situation. So, but yeah, I think it is the play. I mean, if you're lazy, no, I don't want to say lazy. It's just like if you don't want to do the work and you would rather spend 2 hours a night watching Netflix or playing video games or watching YouTube or whatever, rather than researching stocks, do it. Like, you know what I mean? Like, put your money in an index fund. But if you really have that initiative, I don't think what a lot of people understand is like stock market investing can actually be fun. When you know what you're doing, you know what you're looking for. Like, one of the best feelings I get in this world is when I find the next stock. When I get that feeling, I haven't even invested into it yet, but I'm reading up on it and I'm like, oh my gosh, like everything starts clicking and I'm like, this is the next one. That feeling is magical. It truly is for me. You know, I can't speak for everybody. And so, I think some people are like, oh, stock market investing, that's boring. That's like old people stuff. Isn't that or something? And I'm like, dude, like, when you actually know what you're doing and you actually are looking for this stuff, when you find that next one, man, it's a great feeling. I'm sure you might have felt that feeling before. And then you can't wait till the market opens so you can invest in that stock. That is the best feeling, I feel like.
Oh, that's fun. So, is it possible that then, some folks are saying that index funds, they're oversaturated or even like, I know there's a lot of enthusiasm for the ARK funds. Like, what happens when these things get oversaturated? Is it possible that returns are just going to lag on these? And is it better to look for the next fund, or is it just better just pick your own freaking stocks? Like, I guess, does it come down to the individual, or what's your take on that? Are we going to see returns not be as good going forward?
Yeah, I think a lot of it comes down to the individuals, right? For the most part, I feel like if you're in a market where, the market's just been climbing and climbing and climbing, it almost kind of is stealing returns from the future. And you could almost kind of expect more limited returns in the future. Like, let's say the S&P 500 doubles over the next 12 months, okay?
Right.
All that's doing is setting up a situation where the S&P 500 is likely going to lag for years and years its historical performance and underperform or go down, right? Because that would just be completely ridiculous and completely unsustainable. So that's kind of the way I look at it. It's like we're just going to steal returns from the future. And sometimes that happens even in a stock, like, Tesla stock, which is a stock I own and you own as well. And many various people, that stock's climbed so much. It's stolen a lot of returns from the future, especially when its market cap went to 800. And I don't know, at the peak, I think it was 850 billion. That's stealing a lot of returns from the future. And so it's amazing to see that crazy run up. But you just got to understand, like, in the future, like, has stolen a lot of returns rather than a more steady approach where, let's say, it went to 100 billion and then chilled for a bit and then went to 200 billion and then went to 400 billion. When you just go up that much that fast, you're stealing returns from the future essentially. So so that's something to kind of keep in mind. The funds, the fund is a weird space because then you're kind of, you're putting your money with another person versus S&P 500 index fund. It's just kind of invested out there. And so then you're placing your belief in a fund. The problem is what we've seen is a lot of times these hot funds, as soon as they make a big name, they actually start underperforming in future years. Like, once they're already like super, super popular and everybody's piling into that fund. I remember there was a great study done recently. I don't remember who did the study, but what they found was essentially those funds, you might have seen this as well, like those funds started actually underperforming in the future. Once they were already super popular and everybody had jumped in them, they actually started lagging. I think it was just the market in general, never mind their historical returns. And so the people that had really gotten the great returns were the ones that were early in. The ones that did not get those great returns was basically when it was already like super popular and everybody knew that was like a famous person in the fund space. So did you see that study?
It's almost like I do know what you're talking about. Yeah, I have no idea what the source is right now, but I have seen this. What is it possible then that let's see here. If that's true, that these funds underperform, is it a concern to have? I mean, so what if the fund that you invested into got 7% and the other one got 8%? I mean, isn't it just better to be invested in the market? And along that same line, why not just throw all of your cash in and at least let your cash park be the S&P or an ARK fund or something like that?
That's fair play. And I kind of agree with that for the most part. Like, it's better to be invested than not invested. But it really gets back to, what is a person's personal goals with their money? How much ambition do they have around growing their money? That's what it really comes down to. Like, what is like me, as far as me personally, like the way I look at my money, like I've like, from the time I was investing my first few $100s in the market when I was, broke, and it was like 2008, 2009, until this day, like, I was like, I'm not going to try to live a normal financial life. Like, I'm going to try to do some crazy things in this lifetime. And so for me, that just like lit a huge fire underneath me. And I'm just like, I want to go after this and get this. And I want to try to get the best returns all the time possible, while managing risks, so I don't, lose a ton of money or something like that. Right. Because if you lose a bunch of money, then you go down, and then you got to climb back up just to get back where you were, and things like that. And so that was my goal. I'm like, I'm not just here to just live a basic financial life. Like, I really want to do some crazy stuff. And like, I have like huge long-term goals of like changing philanthropy and like being able to give away crazy amounts of money to that. And I'm like, if I'm gonna ever reach those goals in life, like, I'm gonna need to try to get the best returns. So that's me personally. But other people don't want to do that. They just want to get to a mill or two and retire, right? And go, and enjoy time with their family, or be able to leave their job and things like that. Everybody's got different goals. So it really comes down to, what are your personal goals? If you're
for you personally,
yeah.
Oh, sorry. I was going to ask you, kind of on that line, future, first of all, future charity. I love that. Very Warren Buffett as well. Hey, let me build as much wealth as I can, and then go donate big time like crazy. Like, so on point. Like, I love that, really beautiful. So thank you for bringing that up. On that point, what's stopping you from going, and maybe you are, and I don't know, but what's stopping you, if you are being stopped from going heavy on the electric vehicle space right now? Why not double up on Tesla? Why not double into some of these other, I don't know, the EV SPACs or the Neos and so on?
I got you. Yeah. I mean, as far as me in that space, I was obviously fairly early in with the Tesla. A couple of years ago, started investing in that one, bought a lot of shares. And I just feel like I'm good with what I own. And every stock I own, including Tesla, I could always say, well, why not just buy more shares and more shares? Yeah. And the thing is, like, when you have, let's say, 20 stocks, they're all fighting for your attention. And then the thousands of stocks out there that you don't own right now are all fighting for your attention, right? And so you're in this situation, like, where, it's like, okay, if I invest here, then why didn't I invest more into this other stock over, so you get in a tough situation. So as far as me, I felt like I'm good with what I have in Tesla. I feel like and I feel like that stock, if you're a long-term holder, it just makes sense to hold. You know what I mean? Like, I've thought about, specifically the shares I own, the public count, like 750, for months and months, every day, I would think like, maybe today I sell. Maybe I'll just sell 150 shares. Maybe I sell 200 shares today. Yeah. And then I'm just like, oh, no, I finally made a decision about a month ago that I'm like, I'm just not selling them. I'm just going to hold them. Who cares? Let's say it falls 50% and it falls from 800 billion to 400 billion. Oh, well, I can look back and I say, well, man, I guess I should have sold. I don't care. I'm like, at that point, I'm just holding. But yeah, as far as other players in the market and things like that, I need to see more from a lot of these players. There are too early days. So I track Tesla from super early days, like pre-Model S days. I tracked Tesla. I never invested in it because I needed to see Tesla get to a level. When I saw them come out with the Model 3, the numbers around Model 3, and I saw them, what was going on with the company, and the valuation hadn't really done much. It was at like a 30 or $40 billion market cap. That's when I jumped in, because I saw enough that I was like, this is a world-changing company or a game-changing company. Right. And I'm like, okay, let me invest. A lot of these younger players, they're too early days for me. Maybe for other investors, they want to take that risk. But for me, I'm just like, I need to see more. Let's just put it that way. So.
Yeah, on that, there's like Neo, for example. They produce 7,000 vehicles. You got Xpeng, I think they do like 4,000 vehicles per month. And then I was just talking to the CEO of Archimoto. This is like super, super tiny, tiny, tiny company. They think they've delivered like 150 vehicles total. And,
Okay.
they compare themselves to being basically at the early days of the Tesla Roadster. So like, is your thing, are you looking for, hey, I want to see this company's delivered 100,000 vehicles before you'd be more into these EVs? Or at what point do you say, I like the vision, I get in? I know the Model 3 was one of those, but for
Yeah.
these next companies, what's your barometer?
I really need to see it in the real world, and I have to see it in
Mm.
a big way in the real world. That's the real thing for me. I have to see it like that. If I don't see it, like, I just can't touch it. If some company's doing 100 cars or something like that, that's great, and other investors can get involved. But that's not at a level yet where I can say, okay, yeah, let me put my hard-earned money in that stock. Yeah, it's just kind of the way it is with and especially when you have big valuations. That's the thing. It's like, okay, if you get it for a super cheap valuation, you can say, okay, what the heck. But when some of these companies have, billions and billions, if not tens of billions of dollars of market cap, and they haven't proven that much, I mean, it's a big price to pay when who knows where they're going to be in a couple years from now. So maybe it hits it big, and maybe they are the next Tesla or the next GM or whatever, or maybe they're not, right? So
Yeah.
yeah.
So like a Lucid Motors rumored partnership with, or SPAC with CCAV, not something for you in your portfolio.
I haven't looked into that one in depth enough yet to really be able to comment intelligently on that one specifically. So yeah, I mean, if it's a super early days company, probably not. But yeah, I can't really speak on that one specifically. So
How about SPACs in general? What's your take on SPACs in general?
So SPACs in general, I think they're around for the long term. I think SPACs are going to be around for the long term. I think we're going to go through a SPAC bubble. I think there will be, I mean, almost every single SPAC goes up, right? So almost every single SPAC goes up. So, that kind of, that should
It
scare
doesn't
people a
sound
little bit.
sustainable, man.
Yeah, yeah. I mean, that's actually, at least kind of give you a little cause for caution there, or cause, for concern. Like, oh, every single one goes up. But yeah. So I think we're going to go into kind of a SPAC bubble. But I think SPACs are going to be around long term. I really do. I don't think, they're going to go out. I think they'll be a competitor to IPOs long term, and just kind of a different way of doing things. And I think some companies are really, really good in the SPAC space that have been, going through that route. I think some of them are winners long term. I think some of them are going to build super successful businesses. And I do think there are others that, are not going to be here long term. Let's just put it that way, or are going to be floundering stocks that really don't know where they're going, because every stock in the stock market can't be a huge winner, right? Every company can't be a big giant in the future. And, if you have a big valuation on yourself, man, sometimes it gets hard to fulfill that. So,
Yeah. Somebody here in the comments said, maybe you should just go around and buy every SPAC at $10, all because there are a ton of them out there who haven't identified anything yet. There's not even media attention on them. They're just literally shell companies and let's just get them for par value, essentially $10, or pay a tiny premium, $10.50, $11. Is it worth it?
well, I have heard of that strategy, and actually, sadly enough, it does actually kind of make sense, because $10 is kind of the bottom for those SPAC situations, and it's like one of those unfortunate things. Like, I looked into it, and I was kind of wanted to be like negative Nancy on it, and then I was like, oh crap, this kind of could work actually, because the 10's like the bottom, right? And so then it's like, okay, if they get a deal and the stock goes to 12, 15, 20, 25, you make money. So yeah, I think that speaks a little volume about the type of market we're in, when, people are figuring out all these different finesses on the system and whatnot. Bravo to some folks. I have some people that, are in the private stock group, and they message me all on that, that they're doing that strategy. And they're like, oh yeah, one of my, ones I did, just announced blah, blah, blah. And I just made 70% in a day. And I'm like, geez, great for you, man. That's crazy. And it is a strategy, I will say. And it is working for people. So I can't see anything
my
bad about it.
issue has always been, and I have almost and this isn't to like paint with a broad brush here, but one of my issues with $10 SPACs or having a whole portfolio of penny stocks is that if you spread yourself too thin, like let's say you have 100 grand to invest and you're like, well, here's a list of 200 SPACs and you put $500 into each. It's like, cool, you made 70%, but how heavy did you actually go on it? Like that. One of the problems I find in social media is this obsession with rates of return. But then how does that rate of return compare to your overall portfolio? Because it's one thing. Look, put $1,000 on Sundial, and you're like, "Yay, I made a ton of money on it." Like, okay, but how much did you actually make relative to your portfolio? And so sometimes I feel like there's this misleadingness on that we get in social media. What's your take on that?
Yeah, that's a really good point around doing that sort of strategy. And yeah, somebody shared a website with me recently, and it just had like all the SPACs listed on it and what their price is right now, and I guess who their manager was.
Backtrack.
Yeah, something like that. I can't remember. They just shared it with me, and I pulled it up, and I was like, "Holy smokes, this is a big list." But yeah, I think that is kind of the thing that people don't even think about. It's like, yeah, if you just put a little bit of money in all these different plays, okay, like some of them could hit huge, and a lot of them might not do anything for a year or for years or ever, right? Who knows if they'll ever kind of find a deal. So yeah, I don't know, man.
I can go down too, which I think sometimes people forget is there's actually this one. I don't know if you're familiar with it. This used car company competitor to Carvana and Vroom. It's a Shift Technology. It was a $10 SPAC. The thing went down to like $6.50. I bought it around $8. It kind of hasn't moved much. It's like a $9 stock or whatever. Personally, I think it's a huge value play. But then, as with all value plays, like you mentioned earlier, there's this risk. But yeah, I mean, when you look at that, when you look back and like you bought that one for $10, hey, not only did you not do anything, you actually went down.
Yeah. There's no doubt that can happen as well. I think the one part I don't like about the whole thing is kind of this notion of, getting more into these short-term activities and trying to find this, I don't know, if I guess we can call it arbitrage in these different things rather than just focusing on finding the next great company. And so you're spending your time, investing in all these different SPACs and hoping, one goes up short term and things like that. It's like, what if you had spent that time trying to find the next Tesla, the next, Planet 13, or the next Amazon, or the next whatever stock, the next Shopify, because those stocks are out there. And so it's like, well, what if you invest in those and spend your time on that and focus on long-term fundamentals versus focusing on, the next SPAC? But it's an environment we're in. ICOs, SPACs, all these things, but it's a risk-on environment. So people are really just they're looking for these type of things. Yeah, it's just like we started off saying, it's a time period we're in right now. So.
What you've invested into, like, Planet 13, obviously insanely volatile the last few weeks here. We've had some really down weeks for cannabis. We've had some insane ups, net, obviously way up. At what point do you say, this has grown to a point where I've made my money. I've made the money that I expected I would make. Sure, this could keep going, but it's time for me to take all of the money that's in this and just go into another, so number 19, thank you for doing your job. You're gone. Here's new number 19, let's say.
Yeah. I mean, so that's kind of like almost like a two-part question. I mean, with the Planet, the way I kind of view that one, just to be real clear about that, that's like a baby company, right? I mean, there's just so much long-term opportunity there. So sometimes I look into some of these stocks and I'm like, or invest in some of these stocks. And it's like, okay, I could sell that money. And let's say I put that into cash. Okay, well, now I have a cash problem because now I might have too much cash, right? And so that's not ideal. But I really look at it like, specifically with Planet 13, I'm like, it's a little baby newborn. And the way I kind of view it is like long-term TAM. There's going to be companies in that space, whether, the Jack Jackson space, as I like to call it, that are going to be $10 billion or multi-$10 billion valuations. There's just no doubt in my mind when you look at how big that industry is, when that product's illegal. Imagine how big it's going to be when it's federally legal, right? And so I look at a stock like that and I'm like, there's so much long-term op. Yeah, it's over $1 billion market cap and it looks not the best deal short-term, but long-term, that could be the biggest deal in the world, right? So that's kind of the way I view it. And if there's a better stock, sometimes I'll redeploy money. or I'll just put cash into the new stock. So
Right. New earnings and just funnel those in. But then you get over your 20 stock limit.
yeah.
Oh, there we go. Yep.
Yeah, that could happen sometimes too. I usually am pretty good about keeping it around there or under there, but yeah, that's kind of the danger. And sometimes the ones I'll have the most trouble with is some of the ones I've been selling off. And to sell it off the rest of the way sometimes is not the easiest, man. It's like you're accepting the fact that you're breaking up with this company. It's a
You're all
sad
out.
day.
Yeah, it's tough.
Yeah.
That is tough. What about this whole Wall Street bets movement? Let's talk about that. I mean, there's this theory that maybe all you have to do to be a good investor is read Reddit, and just find the trends, like the threads, I should say, on Reddit before they blow up, and throw some money in here, throw some money in there, and then leave some comments about how this is going to go to the moon, and hopefully get some other people in and start a movement. What's your take on that style investing?
Well, I mean, at the end of the day, like, I think there's something to be said about doing research work, in any type of forum or things like that, or getting stock ideas. And I think if that sparks an idea and you see somebody post something, whether it be watching a YouTube video or whether it be on Wall Street Bets or in a Discord chat or wherever, there's some value in that. And sometimes somebody's got a good stock, and it's like the next good stock. And so you actually start doing research and you're like, oh, there's something here. Like, I'll give you an example. 75% plus of my stock picks are now coming from the Discord chat in my private group. 75% plus, where somebody will send me a stock in a DM. And a lot of times it's like, no, I don't like that stock. It's not an industry I understand, da, 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 da. And there's a lot of no's. And then somebody sends me the stock and I'm like, oh, this, and I started looking into it. I'm like, oh my gosh, like, this person found one here. They got one. And I do my full research. Next thing you know, I invest in it. That's happening all the time to me now. And it's or I'll just read through the Discord chat and things like that. So I think there's some real good in that. I think there is danger in it too, where if you're just like simply because everybody's buying a stock, you just put it going in and you're buying it as well. I think there's some danger in that activity. But I think we're living in the best time period ever in history for getting different stock ideas and then going and doing your research and being like, hey, maybe they got something here, man. Or maybe no, it's just crap. No, there's nothing there. And then you find one. So.
So a good way to almost source ideas by listening to the community. That's a good point. Rather than investing blindly, you take these ideas, do a little bit of research. Do I like the premise of this? Is it worth a further dive? And then you kind of go from there, huh?
Yeah, well, the biggest, I mean, one of the biggest problems, like, people come to me and they ask me, it's like, how do I find more stocks? Like, I'm not finding enough stocks. And I'm like, well, you can Google like an SP 500 list, or you can go to different forums, different Discord chats, watch YouTube videos and things like that, where people are talking about different stocks. And you might have to hear about 50 different stocks in a day, and maybe number 51 you heard. You're like, oh, there might be something there. And you start doing research and you find, oh my gosh, this is actually really good. And maybe you find something and it like ruins it. And it's like, no, that's actually not the stock. But yeah, we're living through the best time period in history for getting the spark of an idea about an investment and then trying to go from there and understanding a company on a higher level. And I'll give you an example real quick. So with Tesla stock, when I started doing more research work in that, and started doing more study in that, I remember I came across, videos from Galileo, Hyperchange, right? And, I'd watch a lot of his Tesla videos, and a lot of them confirmed kind of what I was thinking, or giving me different ways to think about the business that maybe I hadn't before. And it gave me more conviction as I did my other research working in the company that I was making the right investment decision. And so that, I think, is a magical thing we're going through right now that we didn't even have 10 years ago, never mind 30 years ago or 50 years ago. And I think that's why it's one of the best times ever to be a stock picker, to be honest, because you get to hear these insights, have people explain these things on a level where you just wouldn't have had access to these people before. The whole money space has been changed so much over the past 5-10 years. It's incredible. Like, you can hear some multimillionaires speak about a subject and get educated on it in a matter of an hour that you would never would have had access to that person in past. Like you never, they wouldn't have gave you the time of day. And even when I started in 2008, 9, being able to go on YouTube and find like Warren Buffett interviews that people had recorded like on a VHS or whatever and somehow upload
Yeah.
to YouTube. That was magical for me because I mean, I never would have gotten a chance to speak to Warren Buffett, but I could watch all these different interviews of Warren Buffett and pick up on things here and there and start putting together, okay, how he invests, how he thinks about a company, how he thinks about investing in a stock. And yeah, it's a magical time. So I think the good way outweighs the bad. I understand people want to, cast it as, it's the Wall Street bets and it's all bad and blah, blah, blah. And it's fun to talk about, but I think the good of this whole like movement of social media and like being able to hear about different stocks, I think it's the best thing to ever happen to people involved in caring about money at all. I'll be honest. So I think, yeah, the good definitely outweighs the bad.
Wow. So a big social movement right now, especially on social media, is around Bitcoin and cryptos. What's your take?
Bitcoin and crypto. So, yeah, I mean, my take has changed a little bit over time when it comes to Bitcoin, cryptos in general, and things like that. So, I think Bitcoin's around for the long term now. There's just so many people invest in it. There's so many people that believe in it huge. I don't think things are ever gonna I don't think the whole argument about Bitcoin's gonna go to zero or something like that. I don't think it's realistic at all nowadays. There's way too many people involved. There's way too many different funds getting involved. That whole like Bitcoin to zero, I think that's just thrown out the window. There's just way too many people that love that it's a store of value. Whether Bitcoin goes to 1 million or 20,000 or those different, that's all up for debate. But I invested in MSTR a month ago or so, or 2 months ago, and that's my Bitcoin play because they own more Bitcoin than any other public company out there. And so that's my personal exposure to Bitcoin. And because I'm like, I don't want to see that whole trend pass and then like not have capitalized on something there, right? Because maybe Bitcoin does go to 1 million. Hey, at least I got some money in and I'm going to make a bunch of money on it. Or maybe it doesn't, and that's fine. I took a limited amount of risk. So in other cryptos in general, I think Ethereum is around for the long term. I just, from all the high level people I have spoken to around cryptos, Ethereum's it's just a game changer in that space, and it's going to be around long term. I think the guy behind that dude, man, he's just like a super genius. Like he's on another level. So yeah, as far as all the other cryptos and coins and things like that, I don't really have an opinion, man. Some of them are maybe have potential, some of them maybe don't. But yeah, I do truly feel like Bitcoin's around for the long term because so many people want to be in it, and Ethereum is likely a huge winner long term as well. So yeah.
So MicroStrategy, don't know much about them. We obviously social media has heard a lot about Michael Saylor and his massive investment into Bitcoin, potentially one of the reasons that Elon Musk invested 8% of Tesla's available or free cash into Bitcoin. Why would you invest into MicroStrategy for Bitcoin if you could just buy Bitcoin?
Yeah, that's something I did get from some folks when I made that investment. So my thought around that is maybe they, because Michael Saylor, he's a pretty bright dude. So I'm thinking maybe he finds other ways to buy more than 70,000 Bitcoin long term. Maybe he figures out, maybe builds it into kind of more of a fun long term, and there's actually more upside there long term. And so, yeah, and also, there's limited risk because they actually have a underlying business model there, right? That company. So, and then I was thinking about all the free publicity that business model got, and I'm like, maybe that helps them as well. So I just kind of looked at all those different various things, and I was like, yeah, I think I just want to own that stock and get from that angle. But I'm not opposed to investing in Bitcoin. Let me be very clear about that, because like I said, I've just it is hard to see Bitcoin not being bigger, let's say in 5 or 10 years than it is today, just based upon the fact that more and more people are moving to it. And just a lot of people want to store their wealth there, whether it's all their wealth or whether it's just a portion, whether it's like 1% or 3% of their wealth there. So,
you've mentioned you've got 22 to 24% cash right now is based on your portfolio. Why not take 5 percentage points of that So, a fifth of that, or even a fourth of that, and throw it into Bitcoin. Do you think if a market crash comes that Bitcoin's going to plummet with it? You'd rather have the cash, or what's your take?
Yeah, I probably should, to be honest. I probably should put it in crypto. And then Graham was, with him last night. He was saying that as well. He's like, "Oh, just buy a couple 100,000 in Bitcoin." He's like, "Just put a couple hundred and things like that." And yeah, I mean, I'm not opposed to it, but I do have other businesses I'm working on the DL right now and things like that that are cash flow needs that are going to be money losers for at least the next year or two. That I'm
Shoot.
having fun, yeah, that are going to be, that are going to lose me tens of thousands of dollars a month, every month, if not 100K plus. So I'm going to fund those businesses. So I'm also thinking about in those terms. And so I'm like, well, if I tie up money in Bitcoin, I could be using that money toward that business or things like that. And what if Bitcoin started to go down in the short term and then I'm like, have to sell at bad price? So yeah, I kind of need cash also for those business needs and around the new one I'm building. So, it is what it is.
Yeah. Yeah, I understand that. Okay, so not opposed to Bitcoin, something you'd consider doing, but right now you've got these cash constraints. You're not going to sell one of your top 20 positions to go into Bitcoin, in other words.
Yeah, not me personally. I have my exposure there with the MSTR, and I'm just kind of like good right now. What happens long term? Who knows? Maybe my thoughts change. Maybe I want to put more directly into Bitcoin. A few years ago, I wouldn't even have considered Bitcoin, and now I'm obviously in it to some sort of extent through that stock, right? So, you never. Times long. There's been stocks in the past that I never would have considered buying them, and then I end up buying them. So that's money for you, man.
What percentage of your portfolio do you have in MSTR as your sort of Bitcoin play?
Very small percent. Probably 1%, maybe even less than 1%. Yeah, so it's a very small amount.
So no Dogecoin for you.
No, not at the moment, although it is hilarious. Funny.
That's awesome.
That's how much money we have in people. It's like meme coins, meme stocks. It doesn't matter. Like people just looking to put money wherever. There's so much dang free money out there right now that people are just like, let's put it in anything.
Is this something? I mean, I know you mentioned earlier in the conversation that the summer is something you're paying attention to, as maybe this next stimulus package passes in March, it goes into effect in April, May. Then we're June, July, August. Maybe no other stimulus package on the horizon. I know we don't have a crystal ball here, but what are you concerned of? Do you see a correction? Is it a crash?
Yeah, it's hard to say whether it's a correction or a crash or maybe nothing, right? But I think I think if you're looking for a time period that's going to be really important to watch, I do feel like it's going to be May through basically July. And kind of what happens there, because let's say we get this next package approved, a bunch more money sloshes out there, and just trying to see, like, do things kind of keep inflating, or do we start to kind of have the market push back? Because you do have some things that are going to be working against the market over, let's say, the next few years after this last package is announced. One, it's like, okay, what do you have coming past that? Are they going to announce another 2 trillion package or 5 trillion? I don't think so. So, okay, so all of a sudden you start having that whole effect kind of leave you, right? There's a very realistic possibility that in the back half of this year, mortgage rates start going up quite a bit. Auto loan rates start going up quite a bit. And some of those rates start to really move up. High probability of that, right? So how does that affect things? Does that start slowing down the housing market? And remember, all these things are kind of dominoes. Like if the housing market starts slowing, does that slow down the stock market? Does that start slowing down cryptos? And then if things start slowing, do people start getting a little scared? Oh, maybe I'll start cashing. And then that actually lead to a little down cycle where, we actually end up, selling out of some of these different things, right? So I think that's going to be just a time period. And then you have on top of that, corporate tax rates. There's a decent probability that, those could go to 28% within the next 2 years. So, if you go from 21% to 28%, that's just less profitability these companies are going to have. There's going to be less money hitting their net income line, right? So when you look at some of those various things, obviously you have the economy coming back, but all that's been priced in. The stock market's at by far and away all-time highs. So it's not like we can say, well, it hasn't been priced in. Maybe with a few stocks here and there, it hasn't, but for the vast majority, it has been priced in. So Yeah, that's why I really feel like this summer is going to be an important time to really see what happens and really see how things kind of play out, because whatever happens in the summertime is going to end up trickling over to the fall time and winter time, and then we're going to really see kind of, what happens. Let's just put it that way.
Huh? Is there are there particular signals you're looking at to watch why you think rates might go up? Particular metrics you're watching, or what are you keeping an eye on, and what's driving you to think that rates might go up at the end of the year? Because that's rates going up is certainly going to have a nice impact on things.
Yeah. What makes me feel like that way is just the mass movement in housing and housing prices going up. And I know California is kind of a different market because there was kind of some things working against you guys with the whole, SALT deductions and things like that. So that might be a different market. But I mean, the vast majority of these markets around the United States, real estate is just going up and up and up. And that's good if you own real estate. But then you get into concerns. What about the people that don't own real estate? Or is housing becoming more and more, less and less affordable to them? And so maybe you try to slow down this massive increase in housing prices that's going on. Like I said, I'm seeing in Vegas big time. I mean, in Phoenix as well, where just, houses are moving. When I go on Zillow now, I like to play around with Zillow sometimes, if I got some time in my hands, and I just go around clicking on houses. And the amount of contingents I'm seeing is like I've never ever seen in Vegas in 5+ years I've lived out here. I moved out here in 2015, right? I've never, it's more houses I'm clicking on are contingent than say house for sale. And so, yeah, I look at that and I'm like, there's definitely a real possibility that, they're going to say, oh, are we going to end up in another huge housing bubble like we had in, obviously back in, 08, it was kind of 07, it really started to pop, right? And so, yeah, and so that makes me think, well, maybe they're going to raise rates and things like that and try to just cool the market, because the markets are just flying, let's just put it that way. So, because, yeah, I mean, it's not a good situation if all these housing prices go to the sky. Yep, you own a house, it's great. And then if you don't own a house, you are getting absolutely trashed. And all of a sudden you have to pay 30%, 50%, 70% more for that same house than you would have paid 12 months ago. I mean, or 24 months ago. Like that's a tough situation. And I don't think, the government wants that. And, because, yeah, then you end up with a lot of other problems, right? And I mean, you know better than anybody, somebody that's lived in California and seen what's happened with LA, seen what's happened with San Francisco, where just so many people are priced out of the market. And then they start making these moves where you can't raise rent, and it gets messy, man. It gets messy. So, yeah. So I wouldn't be surprised at all if mortgage rates climb in the back half of this year.
Wow. So almost because of this lack of affordability, you think we might see rates go up in order to just really kind of dampen this insane run that we're seeing in real estate, not necessarily try to crash the market, but to slow down what could potentially be an overheating. Is that what you're seeing in housing?
That's what I'm thinking. And, if you think about rates and how they move around and those sorts of things, a lot of it is trying to play things where you kind of want, the government, the Fed, whatever you want to call it, right? It's basically all the same thing at the end of the day. They all want to kind of get a little more expensive over time. However, if things are getting, disproportionately more expensive and getting to, unsustainably high levels, then you start worrying about mass inflation. And, specifically when it comes to asset prices. And then you got a whole other host of problems that, man, if things go too high, then you end up with a bunch of problems on the other side. So, yeah, so that's kind of the way I'm thinking about it. And I'm just like, I don't know. Maybe it doesn't happen, but I definitely see a possibility. And I know Fed funds rate, I think they talked in the past about that not raising potentially for years. Correct me if I'm wrong, but I don't know if that's going to play out that way, man. I think things are going to be different than maybe what they've said in the past. We'll see.
So you think they might change course and be almost forced potentially to raise rates a little sooner, which could come as a shock to the market?
I think so. I really am thinking so. And I think it's hard not to make an argument that maybe they should. If you see assets continue to just go to the sky, maybe it makes sense to change the course of action there. So yeah, we'll see how it all plays out, but I wouldn't be surprised at all. Let's just put it that way. If there's a change in the next year or two, because I mean, you know, I know you keep up with this stuff. I think they said in the past something like maybe not till like 2024. And I'm like, I don't know. I think it's more like maybe, you know, maybe as soon as 2022, maybe even before that. I don't know. You know, what's your opinion? I would love to hear your opinion. You know, I know this is kind of more interview with me, but I'd love to hear your opinion as well. If you don't mind sharing it a little bit.
You know, the Fed is stuck between a rock and a hard place. They've got this situation where they want to help the little guy, but every lever they pull to try to help people build wealth helps rich people get richer. People who own stocks and real estate get richer and richer. And unfortunately, for the Fed, their goal is, well, we just got to keep the printer rolling until finally some money starts showing up into the hands of disproportionately women, Hispanics, blacks, and people making less than $40,000 a year. And the only lever they have is cheap money, encouraging businesses to invest. Congress, you can't rely on them for certainly not like a universal basic income. I mean, I don't think we're going to see that for, you know, at least a decade or two in the United States. And so you are left with this high amount of poverty, this high group of people who can't afford housing, like you're saying. But, you know, then on the flip side, yeah, I mean, maybe your Vegas boom is fueled by the white collar workers who are like, hey man, I work at Netflix, man. I don't care if your house just went up 100 grand, I'll buy 4. You know, it's a screwed up economy, man. I don't know what to say.
It's true. It's true. And I do think like sometimes it's, you know, specifically when it comes to Vegas, I do think like, you know, because this is a market I mainly live in, but I'm also seeing in Phoenix, but I do think like, well, maybe it's a lot of the you know, the flee from California over, especially now with remote work, more than ever, you know, flee to Vegas and Phoenix, because I mean, let's be quite honest. If you come from LA, you know, you can get a mansion out here in Vegas for, you know, a price you could get a 2-bedroom there in LA. It's just a total different market. Same thing with Phoenix. Like you
just rubbing it in, man.
No, I mean, you get a huge piece of land, huge backyard, the pool, you know, a modern house that is just beautiful. And it's just like, and so I think like maybe because these are the two main markets I spend my time in, Vegas and Phoenix, I do think maybe I'm seeing an unrealistic side because it's just a lot of California money coming over, and maybe that's you know, changing my perception a little bit on what's going on. So yeah, I do think about these things, man. It's crazy.
Yeah, and it's crazy too, though. I mean, what you've been saying is so right on, though. I mean, just the entire country, you've seen just there was no real estate drop, which is so weird. Like when March came around, I remember I was doing these weekly real estate videos on statistics. Like I had agents send me data from like Florida and the Midwest and California and New York and places, and we're analyzing the data week by week. Like, when's it gonna crack? When's it gonna crack? And we're like, what the hell is going up? You know, like it's so weird.
Yeah, 100%, man. Yeah. And the same thing. I mean, it didn't really happen in the stock market as much. I mean, the stock market, you know, crashed, but then it just came back so dang sharply. But yeah, with real estate, it was just it's a weird, you know, bunch of factors, because you had mortgage rates go to the lowest they've ever been in history, right? You had you know, people caring more about their home environment than ever in history, because they've been forced to spend so much dang time in their home that, you know, a lot of these people in the past might have been like, well, you know, we go out all the time. We're not even in the house that much other than to watch TV or sleep, right? And now all of a sudden they're in their house 24/7, and they're looking around. They're like, oh, I want something better. Let me upgrade. Mortgage rates are super cheap. And yeah, you just have all these different factors, and then remote work. And it's like, well, actually, maybe we don't need to live in the city we live in right now. Why don't we go? We've always wanted to live in blah, blah, blah. Let's go live in Austin, Texas now, or wherever, you know? And so, yeah, man, what a weird time. I gotta say, like, you know, when it went into all this, I mean, a lot of people figured real estate was gonna have to drop. It just had to drop, and it just didn't. And it's just, like I said, I'm seeing it stronger than ever. To be completely honest, like I said, I'm seeing homes move that just wouldn't have moved. I'm seeing land move that was not moving at, you know, this time last year or 18 months ago. And yeah, it's wild.
Are you continuously adding to your real estate portfolio, or are you at this point where no, let's keep looking for those stock deals? Where's your big focus right now?
Well, now my big focus is starting to change because I got the new business I'm creating. So when I think about some of my cash flow needs and things like that, it's really going to be toward that new project I'm going to have. And maybe not as much around real estate. Like real estate, I don't plan. Keyword is plan. You know, you never know. My mind can change in a matter of a snap of fingers by the time I get off this live stream. But no, I don't plan to buy any more properties anytime soon.
Okay.
We got the one being built, then we got the new one in Arizona, and then we got this one I'm in right now. And no, so I really don't have any more plans to add more real estate. And then stocks, I'm always active for a deal in stocks. You know, stocks is just like, you know, you could go from not even knowing about a company to all of a sudden, you know, I do a couple nights of research, you know, deeply into a company, and all of a sudden I have this good understanding. And then I'm like, this is the next stock I'm buying. Here we go. This is the next one, man. So yeah, I'm always open for a deal with stocks.
What are some of your big 10x ideas moving forward over the next decade? Is it maybe does that EV door open up for you some more? Is it hydrogen, climate change? Is it value? Is it this rotation into the depressed recovery stocks? What do you see that 10 years? It's so weird to say, like 2030, 2031. Geez, your kids will be getting ready to go to college, or at least one of them. That's crazy to say, right? But yeah, what are you thinking? What's next for the next 10 years?
Yeah, I mean, so you usually like to view stocks in a 5-year time capsule. I'm usually 3 to 5 years. That's kind of where I'm really thinking. I'm not really thinking 10 years because it does get a little cloudy to see out 10 years. But I do think, in the cannabis space, I think there's going to be some huge winners there. I think federal
Okay.
legalization within the next year or two in the United States of America, definitely within the next 5 years, but I think within the next year or two, it's coming. And I think that's going to make some of those companies are going to go from, very, very small companies to very, very large companies. So I definitely see that as being a huge boom industry. I think the plant-based food companies, I think there's huge potential. I'm seeing what I think is going to be an everlasting change. And I think we're going through a time period right now where diets, the way people think about food, is vastly different than any time period in modern history. I think we're going to go through one of the biggest changes since probably the refrigeration age and microwaves and TV dinners. Like, I think we're going to go through an epic change right now. And so I've been
Wow.
getting into a lot of plant-based food plays, very good food company. Tattooed Chef is my favorite in the space as far as risk reward, TTCF. And then I'm also investing Beyond Meat. So I have a new cannabis play that I can't share with you right now, but I will be able to share it at some point in the future. And that's a really exciting stock. So some of those industries, obviously I'm still holding my Tesla. So I'm still a huge, I truly believe like almost all new cars will be electric within the next decade. Like, it's just even 5 years, it's hard for me to imagine somebody going and buying a new car from a parking lot or from a dealership or whatever. And it's like a new car that's a gas car, even in 5 years, never mind 10 years from now, unless like you're buying electric, there's just no question. And so, so those are some of the spaces I'm really thinking about. Cloud is still interesting because the fact is, and that's why I think I invested a lot in Dropbox. One of the reasons, because, I think cloud is something that is going to continue to boom. I know not a lot of people are talking about cloud anymore because it's kind of like the thing of the past, right? It was popular to talk about cloud 5, 6, 7 years ago because it was like the next big wave. And the wave's still going on, but at the same time, like, my cloud needs just continue to go up. Every business pretty much in the world needs more and more cloud. And so, although it is somewhat of a commoditized industry, that needs around that are just going to continue to go up, right? Memory is going to need to continue to go up. So like memory chips, the needs from like companies like Micron will continue to increase in the future. 5G is going to be a huge boom for a lot of different things, including the economy over the next 5 years. That's why I'm investing in a company like Skyworks Solutions. So, and Qualcomm as well. They're both going to be huge players in 5G and already are. And those are definitely some of the industries I'm keeping an eye on that are just going to be, much bigger, let's say in 5 years from now than they are now. Never mind, let's say in 10 years from now, right?
Got it. So, I mean, let's unpackage this a little bit. I want to start by unpackaging this new refrigeration age here. I feel like, we've had this this movement of like fitness and health for a while here. What's making you identify sort of a large catalyst here that's going to change, look, I still want my chicken tendies, okay?
Yeah. Yeah. I think when it comes to food, when it comes to diets, the changes don't happen overnight, right? You're not just going to get everybody, from eating one different product to eating something else or drinking something else overnight, right? It happens over time, and that's what makes a lot of these stocks exciting. Is it does happen over years and years, so it's not like they're just going to go up to the sky one day and then just drop or just stay there forever. It's a multi-decade really movement. So when it comes to like plant-based foods, I've just looked at this industry and I've seen how much things are changing there. And I just don't think it's slowing. I think it's going to ramp up bigger and bigger. And I'm even watching in my own life, and a lot of friends and family around me eat less related products and move more and more to not like full vegan diets or something like that. Although I have seen some people around me actually go to full vegan diets, including my brother-in-law, who's also my video editor, Chris. He's on a full vegan diet. He's been on it. He loves it. He says he feels better when he's on a vegan diet than he feels if he's eating meats and things like that. So I've seen people do that, but I've also seen it with myself and others where we're trying to consume less meat. And I don't think that's going to slow. I don't think that's going to stop. And I think that's going to continue movement. The healthy drinks is another one. I think that's going to be a huge movement in the future too. With there's not really any stocks I can call out right now around that space, but I think that's going to be a huge movement. More, I see less and less people drinking like soda in my generation. Like I remember there was a time you, Graham, and I took you guys over this little like sushi spot kind of by my house, right? And I remember like I ordered a soda and you guys just got waters. And I feel like if that was 20, 30 years ago, I feel like you guys would have got sodas too. You know what I mean? Like it's just like more people are drinking water or like other products that they feel are healthier rather than like a soda that's got 40 grams of sugar in it. And so I'm watching these things kind of play out simultaneously. And I'm like, I don't think this is going to stop. I don't think this is going to slow. I think things are going to continue to move in this direction. And we're not going backwards on this. We're only going forward.
So, I mean, it's possible that Graham didn't get a soda because he wanted to save the dollar.
More like,
but on the healthy movement, is it possible that, oh man, I'm watching, what is this? New Cajun flounder sandwich here. Come on, man. Hold on. Let me see if I can put this up. Come on, man. Like, this is literally, as we're talking about this, this is what's on TV. Hey, look, there's Walgreens.
Oh, yeah.
Hey. But jeez, but I gotta know. I mean, like, is this food movement just gonna be slow? Like, I want money fast, man. I mean, we've had soy for a while, soy stuff and the plant-based stuff has been around for a while. But I want to make some gains, faster. Why don't I invest in like the next generation space companies? Companies sending satellites to space. Why would I invest in tattooed chef who's smashing, I don't know, whatever beans or whatever to make food?
Okay, so that's a deep question there. Two parts. One, Netflix I think is accelerating the whole movement, and through a lot of the Netflix documentaries, I think in social media, Netflix, all these things are just accelerating movements way faster and bigger and more widespread than any time period ever in history, right? And I see like the vegan groups, like my wife's in a vegan group, even though she's not vegan, which is kind of funny. And then obviously my brother-in-law, and like those groups just continue to get bigger and bigger, and people share ideas and thoughts and, oh, what's the new restaurant? And they go support it like crazy. And like, it just, movements are easier to happen now than ever before, right? So that's one thing. Second thing is, these companies that I'm talking about are growth beasts. I mean, there's nothing boring about those stocks. Tattooed Chef will likely grow revenue in 2021 over 50%. That's a lot more than the high majority of companies out there. Very good food company, another stock I'm invested in, right? They just grew revenue last quarter 322%. So, Beyond Meat, look at the numbers Beyond Meat's posted over the last couple of years. And now they just announced a new deal with the new product line with PepsiCo, which gives them crazy distribution, right? Possibility of a McDonald's partnership there. They just announced a deal with Pizza Hut about a month or two ago. Potential there, Taco Bell's testing the products. So you look at this industry, like it's a last thing from like a boring industry. There's so much growth. And the thing is, it's like multi-year growth. So it's not like these companies just grow one year and then they're done. It's like this is going to be lasting for years to go in the future with crazy growth. And I mean, these stocks have grown. Look at Beyond Meat stock over the past year. I think in the lows, in the March crash, I think that stock was under $60, and I think it's 170 today or something like that. Very Good Food Company was just a teeny guy, and now I think I've made at least a few 100% on that one. So I think it's one of the most exciting sectors and spaces like anybody can be invested in, to be quite honest with you. That's my opinion. So
got it. And is it potentially that these companies have seen these multiples because they're so tiny and they're growing out? Like, how do we go from tiny to building out to actually mainstream? I think that's almost the transition there. That's going to be the big move, is trying to get more mainstream, or are we already?
I think it's going to be a continued movement. You look at something like Beyond Meat, like no one heard of Beyond Meat 3 years ago. Like, unless you were super up on, I don't know, vegan products, no one had any clue about Beyond Meat. And now that company, in a matter of the last, just let's say 36 months, has all of a sudden a household name in the United States of America, if not, in many other markets as well, but certainly in the United States. That's crazy to really think about that, right? In such a short amount of time, to go from no one heard of this to like, it's a household name. And I think a lot of it is about getting the right employees in place, because what a lot of these companies are going to steal away, they're going to steal away a lot of the employees of some of these older food companies that those companies don't have much growth, right? They're just barely trying to maintain market share in whatever product categories they sell. And for some employees, that's fine. But some employees, they want that growth. They want to have expansion opportunity up the ranks where it's not so bureaucratic. They want, to get them in all the different retailers and things like that. And so, I think they're going to attract some of the top talent and some of the biggest go-getters from the big food companies to the next wave. Because who doesn't want to be, would you rather work at, I don't know, Chips Ahoy, where you're barely trying to do the same numbers every year and it's just a very mundane thing? Or would you rather try to jump ship if you're a real real go-getter, and go to one of these other companies that grow, 100% this year, 50%, and be part of that and be like, wow, yeah, this is what I'm part of. I'm part of a company that's actually growing and doing things, and I got all these different roles. We'll see.
Is that something that could happen with like a Tesla as well, where they're so ubiquitous for being number one that they attract better talent, and by attracting better talent, they continue to be number one?
Yeah, absolutely. Yeah, no doubt. I think all the big, I don't think it's just Tesla. I think anything in the big tech sector kind of gets that. It's such an unfair advantage because, for the most part, most of the top people, right, that are, let's say, engineers or things like that, whether they're brainwashed into it or they just think it, like a lot of them are like, oh, I want to go work for Google or Facebook. And so, a lot of those companies, kind of like the rich get richer. And a lot of those companies get a lot of the best talent. It doesn't mean they get everybody, but they get a lot of it. And, so it's kind of almost unfair. And yeah, a company like Tesla, it's like, would you rather work at Ford or GM or Volkswagen or Mercedes, or would you rather go work at Tesla? You know what I mean? Like just, I think I know where people would rather work. So,
there's this new SPAC called Holicity. It's like it's merging with this company Astra. They're going to send, they want to send like 300 satellites to space, more than SpaceX can, but smaller ones or whatever. I guess the question is, why go work for Holicity if you could work for Tesla? If you can't get into Tesla, is there a reason you can't? And then do you get stuck at sort of the B player, or is that not the right way to look at it? Is it totally okay for there to be multiple market leaders? And is it better to invest in the market leader? In which case, second question, why not invest in Beyond Meat? Why bother with the little companies?
Yeah, I mean, each company has different strategies, I found. So not everybody's going to do the same. So for instance, The three stocks I'm in, that let's say are in the food-based plant, or food, based plants or whatever, that whole space, right? Very good food company, Tattooed Chef, Beyond Meat. When you really break it down, they all have very different strategies. So Beyond Meat, they want to get into all the big fast food chains. They want to make your actual hamburger that you put on the grill, right? And your steak and all those different meat related products, right? A Tattooed Chef wants to be in your freezer. They want to make all the different frozen goods, stuff you heat up in your microwave, stuff you cook in a pan. So they want to really attack that industry. Maybe they get into other industries over time, but that's really what they're trying to do, right? And so all Tattooed Chef products, you'll find them in like different Sam's Clubs, Costco's, Walmart, Target. They're all in the frozen food section. Very good food company is trying to create maybe like a baby Beyond Meat type company where they're going about it in a different way with different products and things like that. But they all have different strategies. And so it's not always like it's one, especially in food, because that's such a big industry. It's not really like there's one winner and everybody else is losers or laggers or something like that. In automobiles, it might be that way, right? Because, it might just be that way. But even in autos traditionally, that's a space that there's a ton of different companies. There really are. There are only a few big winners, but there's a ton of, and I think Tesla has a chance to be 25%, 50% market share in developed markets long term, which would be a number we've never seen. But there's a lot of different companies that compete. Smartphones, that's a funny space, right? Everybody thinks Apple, Samsung. A lot more companies make smartphones than Apple, Samsung. It's just the one that we can, are considering. It's like, okay, you're going to buy a Samsung, you're going to buy an Apple. Okay, I'm buying, Apple.
So in other words, there could be plenty of winners. You don't necessarily have to be in number one, but in some sense, it kind of does seem like number one might give you some of the biggest returns, but I guess not if you get into some of them early, huh?
Yeah, well, you have to break it down space by space. So like Tattooed Chef, in my opinion, is the number one, at least in terms of companies you can invest in, the number one player by far when it comes to these, plant-based food products that are in your freezer, that are frozen foods. They're the number one in that market. Beyond Meat is clearly the number one player when it comes to plant-based meat products. So you kind of have to take it based upon what segment they actually compete in, rather than just from overall food companies or something like that.
There's a comment that comes up a lot. It says, Beyond Meat, so much sodium is, for example, one that I highlighted here. Any thoughts on that? I mean, if it's a health move direction, but maybe the plant-based foods have more sodium, is that a concern? Less saturated fats, but now you got sodium. So it's like,
Yeah, I looked into when I first started trying some of these products, Impossible and Beyond Meat. It was probably over a year ago now, and I was under the impression, oh, these must be super healthy for you. And I don't remember if we went to Carl's Jr., Burger King, or maybe we went to both and got different products. And then I looked in the nutritional facts. I was like, oh, this isn't actually that much more healthy than traditional meat at all. But then you got to understand, not really trying to create something that is nasty and you don't really like it, right? Especially if you're trying to compete in that space. It's got to be good. And I got to say, when I eat a Beyond Meat burger, really dang good, I gotta say. And maybe if they didn't put that much sodium or different products in it, then maybe it tastes like trash, and then then you don't get the whole movement, right? I mean, if people don't like the product, they're not going to eat it. As simple as that. You've got to make good if you're going to switch people over to that diet, and maybe over time you cut back on some things here and there. And but if you're going to accelerate the industry, you just have to put different ingredients or salt or whatever to make it actually taste good, where it's comparable with an actual Whopper, let's say, or an actual burger from McDonald's or something like that.
Yeah. Well, okay, let's move on to, for a moment, Dropbox. So Dropbox. this is one, I feel torn about this one. You've got DocuSign and VeriSign, huge competitors to HelloSign. You've got sort of this decreasing share of the cloud-based storage for Dropbox, but it's an increasing balloon. The TAM is going up, total addressable market. Why wait for a Dropbox when you could take that money and throw it into Tesla some more, especially since you did just say you think Tesla could be a 25 to 50% market share, which has never been done before?
Yeah, Well, also we got to keep in mind the valuation of Tesla's at 800 plus billion, or at least it has been recently, right? So it's like it's priced in a lot of good news for a lot of years. So or different stocks like that. Dropbox was attractive as an investment opportunity, and I don't have as much money in Dropbox as I do Tesla, from my understanding. But Dropbox is really attractive, and I know it is kind of a controversial stock. If you're like, I don't know about that one. The forward P's usually, at least recently, has been around, I think, 25 or under 25. Okay. So they have basically no customer concentration, and their customers, their core customers, are very loyal. Like, I'm not getting rid of my Dropbox account. I've been using them since I had my real estate marketing business back in 2015. I still use them for almost all my cloud needs. That's still my go-to. It's the easiest for sending links and doing different things. I love it. And so I just, I consistently, like, they could go up $20, a year or whatever. I'm not switching. Like, I'm not switching all my cloud crap over to some other service. I love it. Like, why would I do that? So they have pricing power with me long-term. They have such a low customer concentration. They're not one of those businesses where it's like, well, they get 30% of the revenue from this company over here. So if they lost them, they would be screwed. Like I said, the company's cheap, good cash balance on that company. The Drew Houston, the CEO, he's connected with everybody. He's on the, he's friends with Zuckerberg. So, I think that's always a good thing. And involved with some other companies with the guy who's the head of Salesforce. I think it's a buyout candidate if some company want to buy them. Super profitable business model long term. Yeah, HelloSign. There's competition in that space, but HelloSign will never be able to be number one there, right? DocuSign's already won, but I think HelloSign at least has an opportunity to be number two. And that the e-signing of documents a big potential. And also it's all about integrating the HelloSign with the Dropbox, and like you sign something and then easily be able to like put it in the cloud in Dropbox. And so there's kind of like you get that integration there. And the smart workspace, kind of thing they're doing. I think that's interesting. So I just looked at it overall, and it's another one of those risk reward candidates. It's like, okay, what are the chances I lose 50% of my money over the next 3 years on the stock? What's the chance I double my money? And I said, there's a high probability, in my opinion, I double my money. Very low probability I lose 50%. So yeah, it's another one of those.
No, that makes sense. I agree with you. I don't think not DocuSign. Dropbox is not going to 12. Like, it's not happening. No, I agree with you. So here's an interesting comment that came up, going backwards just for a brief moment here. Freezer foods are losing to fresh. It makes me think a little bit. Robo-taxis, drone delivery. Do they have a point?
I mean, I think there's a market for both. I really do. I think there's I think frozen foods will still be relevant, a long time in the future. I think fresh foods will be relevant a long time in the future. I think, there's different needs, different products, there's different ways of doing things. Like, I don't really want, ice cream that hasn't been in the freezer. So, you know what I mean? There's just different things and different use cases for different products and those sorts of things. So, fresh isn't always possible. It's not always the best route to do things. It's not always the most cost efficient manner. And so sometimes the foods, went out in certain spaces. It just depends. It's a case by case basis. So yeah, I think there's plenty of room for.
Oh, sorry. You getting into therapeutics at all? CRISPR, gene editing, these DNA future things.
No. Yeah, no, not because I don't believe in them, just because it's over my head. I'm not afraid to say, like, sometimes these things are just over my head and not in my circle of competence. And if it's not in my circle of competence, I can't invest in it. If I'm going to put my money into something, I really have to understand on a super high level and be extremely confident in it. And it's just the industry's a little over my brain. My brain might not just quite be big enough for that stuff. So it's hard for me to
no worries.
This company is, because I have to be able to if I can't give a super strong bull case for a stock, then I can't invest in it. And I can't do that with those not knowledgeable enough on that industry. So maybe in a few years from now, maybe it's different and I understand it well enough. But as of today, I'm just not there mentally enough to be there. So
got it. What's stopping you from, why don't you just create a fund, where you can actively manage people's 20 stocks?
Yeah, I mean, we've thought about that and we've discussed it, and the team, we've discussed it many times, and it's always a possibility to maybe go there sometime in the future. I just yeah, there's a big project I'm kind of working on right now that I'm really excited about. There's only so much time in a day. But yeah, we've talked about potentially starting like a hedge fund, and we've talked about potentially starting an ETF, and we've explored those different routes and things like that. I just don't feel exactly the time is right at the moment. A few years from now that could change, but right now, I got a little too much on my plate to bite off that as well. Because if I ever do anything, I really want to do it well, and I want to be good at it, and I it to be just some like little side project. And yeah, so timing's not quite right for that at the moment, but maybe in a few years it's different.
Gotcha. Some questions came up for you about selling covered calls for some passive income. Thoughts on that?
Yeah, it's not a bad strategy. It's not. Sometimes you can limit upside by doing some of those type of plays. So that's kind of like the one downside. But yeah, it's not a bad strategy. And I know people that literally make money just doing that. Like that's their whole strategy pretty much. I mean, kind of gets into there's only so much time in a day, and it's like, would I rather focus on trying to, do that, or would I rather try to focus my time on trying to find the next stock or something like that? So, yeah, I don't personally do it. A lot of it because of those reasons where it's like time constraints, and it's like trying to look in and be like, where can I get the best, premium there and things like that. So, but yeah, it's not a bad strategy, and it's not a super risky strategy. There's a lot of option strategies that are high risk in that. For the most part, is not one of them. So yeah, it's not bad.
Did you get into the? I know you got into AMC, but did you get into the GME?
I'm not in AMC. I'm not in an AMC.
Oh, you did.
Yeah.
Okay.
Yeah. In that video, I said basically if it goes to 5 or below, I'm going to start putting money in. And it hasn't hit that yet. It's at 550 or something. It has been recently. But yeah, if it hits $5, I'm buying some. If it goes to 450, I'll buy more. And if it goes to $4, I'll buy more. Just to be clear on that. And then GME, no, I'm not in that one. And I don't have plans to be, but I will say, what's funny, although it's a meme stock, things like that, I actually looked at their most recent quarter. Their numbers weren't bad. Like they actually reported some pretty impressive, numbers in some areas, and especially around e-commerce business and things like that. I didn't think it was the disaster I just assumed it to be when I first heard about it. And I was like, GameStop, yeah, I saw some of their numbers. I was like, man, this quarter was not bad. You would have thought the company, based upon the way people talk about it sometimes in the media, like it's done. But I was like, dang, it's actually, yeah, it wasn't too bad. But no, I'm not in it.
Got it. Yeah, it makes you wonder how much is from the recent, console cycle. Which I wonder how much longer we're gonna have consoles before it's just all, integrated into a smart TV and an app.
Yeah, I know that's a good question. Yeah, I don't know. I mean, the thing is, it's hard sometimes is how you pull that off and the mechanics of that. And then it's like, does Sony want to then do a TV, or do they have to do partnerships with companies? And does that create a messy situation? So yeah, I think that's why certain things haven't moved as fast as, maybe previously thought.
Got it. So somebody here in the chat asked, Joel or Joel asks, ask Jeremy about his biggest failures in the stock market. You touched on 2015 earlier, but maybe we'll let you broadly respond.
Yeah, some of my biggest failures in the stock market, that's for sure. The year that was just really rough. That was that was no fun. So I mean, obviously I kind of already talked about that. Obviously I not every single stocks I pick is going to go up, right? So, GoPro back in the day, like 2016, 2017, that didn't work out. CCL didn't work out, which was one I got in late 2019. CCL didn't work out because of a once in 100-year health event came out of nowhere. Like it was just really bad timing. I bought that stock. It was a really good deal. And then, all of a sudden they weren't allowed to do cruises anymore, like overnight, and the whole business got shut down. So that was unfortunate. GoPro was just a bad management team there. Trying to think of other ones that didn't work out. NAT didn't work out. That was just too short-term of a play for me. I got too trying to make some short-term money there, and it ended up not working out. And that's about it I can really think of in recent times around some like, failures that didn't work out. I would say actually the biggest failures is not like a stock situation where I lost money like a CCL. The biggest failures I've had in the stock market were stocks that I just didn't invest in. So, like for instance,
Mhm.
Amazon. First time I looked at Amazon, it might have been 2010, and I do my research in that company, and I just thought the company was too expensive. Rather than looking at it from an opportunity long-term perspective, I looked at it as what's a P ratio? Oh, they're not even profitable. Oh, look at that price to sales ratio. So I looked at it too short-term focused rather than really viewing, okay, where's Amazon going to be 5 years, 10 years from now? And so it
Mhm.
prevented me from buying a stock that has gone up, thousands of percent since then, right? And there's various stocks. Those are the biggest mistakes because if you lose, 10K, 20K, 30K on a stock and it was a bad investment, it didn't work out and you sold for a loss. Okay. That sucks because you got to kind of build that money back. But it's way different when there's a company you looked into and you didn't get into it for whatever reason. Maybe you were being a little too greedy about, it needs to go to this certain price or something like that. And next thing you know, that stock goes up 1,000%, 2,000%, 3,000%, and everything happened in your bull thesis. And the other biggest failure in the stock market for me is sometimes I'll sell stocks too soon. So,
Mhm.
I've gotten better with that in recent years as I've gotten more and more disciplined over time. But I can tell you, a lot of my early days, I got out of stocks too soon. After I made my first 50% or 100%, rather than like some of these stocks had multi 100% opportunities, and I got out of them just too darn soon. There's so many of them I could name. It's just ridiculous. So those are actually the biggest failures, and people don't look at those as failures because you still made money, and they're like, well, a profit's a profit, but they don't realize how much money you missed out on because you didn't buy that stock that you looked into, or you sold that stock too early. The amounts of money from those is way bigger than losing a little bit on a stock that just, it was a bad play or something like that. So, yeah.
Yeah. Wow. No, that makes a lot of sense. So, really, it sounds like oftentimes you regret not getting in, and you regret selling when you do. So, have there been times you've just thought, maybe to prevent that regret, I'm just going to buy this and then kind of see how it goes, or is that potentially too dangerous?
No, I developed kind of like a framework for thinking around growth stocks a few years ago, around the time I got involved in Tesla, which was really looking at the TAM opportunity, the total addressable market. For those that don't know, what that is, the total addressable market, and thinking about that from a long-term perspective, running revenue numbers for where I think that company can do. In order to run revenue numbers out 3 years from now, 5 years from now in a company, you have to have a super high level understanding. So you had to read the 10Ks, 10Qs, looked at the industry in depth, and understand on a very high level. So I'll start to run revenue numbers, and then I'll say, okay, for this industry, for this company, what they're doing, what's the realistic possibility that 10% of the money reaches net income, or 15% or 20%? I'll kind of run a model based upon that, and that lets me know if I should get in a stock. Now, sometimes I'll run those numbers 3 years out, 5 years out, and it's a ripoff. And so it's
Mm.
like not a good deal. Like it's still like insane valuation, even if I run the numbers. However, other times you'll run them and the stock will look like a ripoff based upon what the company's doing today. But when you run the 3 year out and 5 year out numbers, you're like, this stock is a deal and a half. And so that happens sometimes. And a lot of it's just maturity in the market and just understanding growth stocks on a little higher level of it's not about what's going on just today. It's about what's going on over the next 3, 5, 7 years.
Right. Speaking about the next 3, 5, 7 years, I want to touch on YouTube. You've got 3 different channels on YouTube, and we've got somebody here, Gavin says he watches both of us. He's 12 years old, started his own business in Port Hueneme, which is not too far away from where I am. Invests in stocks that we talk about. There's somebody else here who says I'm also 12, which is
Well,
absolutely incredible. I know, that's amazing. And when I was 12, I was playing RuneScape, you know,
yeah,
but I still play RuneScape. I played RuneScape in November, but talk to me about YouTube. Like, what do you see for the future of YouTube here the next 3, 5, 7 years?
YouTube in the next 3, 5, 7 years, it gets a lot bigger. I don't know
Yeah.
if you're talking about specifically or just YouTube in general, but I think it's going to get way bigger, way bigger. I don't think things are slowing down. I think they're just going to continue to get bigger and bigger. I'm really bullish on YouTube. I've always been bullish on YouTube. That's why it's the number one platform I care about. Is no platform I spend as much time posting content, thinking about content than YouTube. Instagram's number two. And then actually, I'm going to take Clubhouse pretty serious. Graham convinced me last night.
Really?
I got a Clubhouse account now, and I'm actually going to go hard on, hard is relative, but I'm going to start posting content on Clubhouse. Because, yeah, I actually think I was looking at that, and I was like, for my type of content, I think there's actually big potential there. But, yeah, there's not a lot. Yeah, there's not a lot of spaces that really excite me that much when it comes to social media content, posting, those sorts of things. But I will say, yeah, Clubhouse is interesting. But yeah, YouTube, oh my gosh, there's just so much dang growth for YouTube long term. You've seen what's happened in the finance space. Like, this is a whole genre that was, when I started on YouTube in 2016, it was dead. Let me be very clear. Like, there was no such thing as a finance space on YouTube in 2016 when I started posting videos. And it's just been fun to see it build out to this massive thing where, some of the biggest creators in the world watch our content now. People from, celebrities and athletes. Like, it's crazy. Like, some of the DMs I get, and I'm like, this person watches my YouTube channel. Like, this is the starting, quarterback of this NFL team over there, and they're watching me like post stock. Like, this is you know what I mean? And I know everybody in the space is like that are, big names in the space where they'll like, did you know who hit me up on Instagram the other day, blah, blah, blah. And I'm like, what, and it's fun to see it get to this level. And you just think about other genres over time, it's going to get bigger. It's just, it's one of the biggest things to ever get created in mankind, in my opinion, YouTube. Definitely one of the biggest, and it's just going to get bigger.
So why Clubhouse then? I don't even know. This might sound noobish. I mean, I've gone in there for, just to listen to like the Robinhood CEO or Elon or whatever. Is there like recorded content? Like, what do you see there that YouTube doesn't have? Here I am getting defensive about YouTube. Maybe I'm just curious. I don't know.
Well, I think just a different medium, and I think you got a different group of folks that are on Clubhouse, and there's a lot of money on YouTube, on Clubhouse right now, because there's a lot of business people on Clubhouse right now. And it's a platform that's really based upon, from what I'm seeing so far, it's really a platform that is built around business, investing, these different kind of money related disciplines and things like that. And that's just different than what YouTube provides, right? YouTube provides the biggest audience, in my opinion, or at least one of the biggest audiences you can get on social media and a way people can find you. But this Clubhouse, I feel like, especially if you're already, built on social media, I think it's going to be phenomenal for our type of content and our type of space. The only thing I do worry about is it only allows 5,000 people per room, from my understanding right now. And I'm like, long term, that could be bigger. Because look at, your live stream gets, 12,000, 15,000, 20,000 people watching, probably a lot more than that sometimes when it's some big update or something, right? Like, you can't do that on Clubhouse right now, because if the room's limited at 5,000, you can only allow that many in. So yeah, I definitely see that as kind of being an interesting space. It's audio only. So yeah, I don't know. I'm going to definitely do some things, because thing I found is not everybody's on all the different social medias. Not everybody's on YouTube. Not everybody's on Instagram. Well, I don't know. Instagram, everybody might be on Instagram. Not every, it's just, like, I never really go on Facebook. I never go on Twitter. Well, maybe every once in a while if something's trending, but hardly ever. And, YouTube has always been my love. Like, even if I wasn't a YouTuber, like, I used to watch so much YouTube back in the day. Like, YouTube's freaking amazing. So, yeah.
Wow, that's interesting. So do you ever invest in, some people say they like to invest in the brands behind the brand, like, the data providers, the more kind of in the background, like, I guess somebody here in the comments says Amazon Web Services helps with this, or we've got, Fastly that helps with TikTok. Do you ever look into those as investments?
Yes, I do. Yeah. And there's a company, I believe, that's behind Clubhouse that is actually a public company that is going to make bank. I haven't looked into it in depth enough. Somebody shared it with me recently. Some sort of company is behind the technology, and it's a public company. So I gotta look further into that. You just brought up a good point there. And I'm like, this Clubhouse thing, I think this is going to take off. I think this is going to be huge. And so I'm like, if we can get into that company that is basically providing the service behind it, you know, that could be crazy big, right? But yeah, I mean, a lot of those
Yeah.
stocks, man, a lot of them just trade so rich that even when you're running the 3-year out numbers, they still look really, really rich. I can't speak for every single one of them, but yeah, sometimes I do look into them and they're interesting. It's just sometimes, you know, it's just, you know, yeah, everything's worth a certain amount of money, and sometimes it's just like, geez, man, this is crazy. Even if you go years out.
It looks like it might be Agora, agora.io. And this
Okay.
is a service. Let's pull it up here. So, agora.io, and they do a video and voice connection. So it's, oh, hold on, let me change this little screen here so you can see this a little larger. But video and voice connections to, it basically does the backbone for you, and then these companies, they pay by the minute or whatever. So maybe that's what like companies like it, maybe, I mean, not listed here, but like Zoom use in the background as well. So Agora, that might be the one to look into then.
Yes, that's the stock, by the way. Yeah, I remember it was something
Yeah.
that started with A. Yeah. So I'm gonna have to look into that and see what that going on there. Because I mean, if that clubhouse keeps, you know, let's just say getting a lot bigger, I'm sure that company's gonna. But then I'm gonna have to look into so where my brain starts going, just for people that for some context, where my brain starts going when I hear about something like that. So first, I got to make sure it's confirmed, like that company, you know, like Clubhouse uses that Agora. But then where my brain starts going from there is like, could Clubhouse eliminate them somehow and have their own technology that's better and cheaper? So then I have to research on such an in-depth level that I can at least understand that and be able to say, okay, no, that's not really realistic. Or maybe, yeah, Clubhouse could just eliminate them long term. Or maybe there's a competitor that they could go to. And so, yeah, that, you know, just a little context around that.
Yeah, I mean, that's kind of like Tesla. You know, they had their partnership with Solar Edge for solar inverters, and then Tesla's like, we'll just make our own. You know, I mean, I don't know if doesn't it feel more risky then?
Sometimes, yeah, no doubt. So sometimes it can feel a little more risky. You're talking about from the company that's providing past technology to a new company, right? Just to make sure.
Yeah.
Yeah.
Yep.
I mean, yeah, sometimes it can, but sometimes those companies' opportunity long term is so big. So, for instance, you know, Tesla used to use NVIDIA chips in a lot of their cars, and they decided to go to their own product. You know, just because that happened, it doesn't mean NVIDIA's, you know, a bad stock or something like that. Like NVIDIA's opportunity is so big, so you really have to take it on a case by case basis. But yeah, sometimes, like, who cares? Like the TAM for that company is so big, it's like it really doesn't mean that much in the end. So.
Endless. Oh my gosh, that's crazy. Okay, so what's next for you in the short term? And I got to ask too, why? Let's actually start with this question. Why 3 channels? Like, can you explain the difference between the 3?
Yeah, so well, obviously the main channel started back in 2016, and then I started feeling pressure around views and things like that. So then I made financial education too as like an outlet where I don't have to care about views. And then, you know, in the algorithm, you know, because that's the thing, you kind of get into this whole like algorithm and like, oh, I'm not a favorite with the algorithm. Now YouTube doesn't like me anymore, and they're not pushing my videos to subscribers and things like that. So, but then a financial education too became a channel where I had to end up starting to care about the views and the algorithm, because then it was like it got to really big levels, right? And so then the next outlet, so Financial Education 3 is my new outlet where I just post whatever I want to post. I'll probably post something on there later today, like just record it on Loom or whatever. I'll, like, if I'm doing a house tour, I'll just post random content. And it's like that for me right now is like that channel where I'm like, if a video gets 20,000 views, who cares? Like if it gets 100,000 views, great. Like, you know, it's that creative outlet. And I'm going to try to keep that channel like that, where it's a true creative outlet. Because yeah, there's sometimes I want to make certain videos, but I just can't post them on the main or second channel. They won't do the numbers. And then, you know, as a YouTuber, it's like you don't hit a certain number, you know, in your last video, you get even less push on the next video and less push on the next video. It's just, you know, it's not a fun situation. Let's just put it that way, especially, you know, if you're putting out limited amounts of content. I don't, you know, guys like, you know, like for instance, Andre, you know, I got a lot of respect for him, man. What, you know, that's tough. He only does, I think, 2 videos a week. And I'm like, the pressure to only put out 2 videos a week on one channel and, you know, try not to get out of favor with the algorithm. That's a lot of stress and pressure, man. For me, I don't really as much since I have 3 different channels. So yeah, we'll see.
Ah, okay. So it was the way to take the pressure off. Is this sort of an introduction to financial education 4 or 5?
Yeah, I know. Yeah, it could be someday. Yeah, and then last night I was telling Graham there's a high probability within the next 12 to 18 months I don't even post on YouTube anymore, that I actually leave YouTube, like, but don't tell anybody. So yeah, because I'm like, I was looking at
Wait a minute. Wait, what? Why?
Well, the way I was looking at it is because there's the new company I'm starting, and so I'm trying to get everybody on my team mentally prepared. Like, there's a possibility I could never post on YouTube again within the next 12 to 18 months, because that new company could end up taking a lot of my attention and time. And YouTube is very time intensive. Let's be completely honest. Like, if you're a top creator on this platform, it is extremely time intensive. There's no one I know, whether it's you or whether it's Graham or Andre, where we don't use the majority of our mental capacity around YouTube and things like that, right? So there's only so much time in a day. There's only so much mental capacity. So if you're trying to run another big company that's off of YouTube, let's say, where's your time and attention spent, right? And so if I'm going to a true 9-figure, 10-figure type company like we're going to try to create in the future, am I going to actually be CEO there, or am I going to be a figurative CEO where it's just like, oh yeah, he's the CEO, but he doesn't really do much because he's always over there posting YouTube videos all the time? Or am I actually going to be in the nitty gritty and getting everybody to perform on a high level and things like that? So, one thing I do know is if I stop posting, the stock market's going to crash for sure. It's just the whole thing's over.
That's it. That's it. Nobody will have guidance anymore. It'll be over. Wait, I'm shocked by this. I mean, can you give us like a teaser or a hint here on what's this secret, man? Like, you got to keep the market engaged so we know what this secret is. Something.
No, I can't yet. When it gets a little closer to launch time, I'll start letting people kind of know a little bit. But yeah, it's a little too early right now to let people know. And it's very possible I could YouTube videos in 7 years from now, right? So I don't want everybody to think like for sure, like, oh, Jeremy's leaving YouTube in the next 12 to 18 months. But I want everybody to be mentally prepared that it is a realistic possibility that I, go cold turkey basically on YouTube within the next 12 to 18 months.
12 to 18 months. But you would have to prove your business first. I mean, you're not going to go cold turkey until you prove your other model, right?
Correct. Yeah. So we'll see how things kind of work out over time, how that builds over time, and also what my needs are based there. Sometimes I can get people in a really good place where I actually don't need to put in a ton of time. So like my other business around like, the private stock group and things like that, like I don't manage much in there other than post the content and like information on the stocks I'm buying and video related content. But I don't manage any of the day-to-day operations for the most part. I'm the CEO, but I'm just like, I'm pretty disconnected. I have people that run the different departments. And it's like, this person's in charge of the coaching program, and this person's in charge of the sales program, and this person's in charge of all those people, so I got a pretty good structure there, and maybe I get that with the new company. But I want everybody to be like mentally prepared just in case, like, hey, we need to make sure we're get ourselves to a good place where, just in case that happens. So yeah, I think
but why not do like just hire some camera dude or whatever, follow you around? Like why potentially disconnect? Is it just, do you not like that style so much, or what are you thinking there?
Yeah, I don't know. That's a possibility. Do like a Gary V type thing.
There you go. Yeah.
I mean, there's a lot to think about, and maybe it doesn't happen. You know what I mean? Like maybe I'm still, posting a ton of content in the future. You know what I mean? Like, yeah, there's so many different things that can play out. But the bottom line is, I always have to get like, the team and like the company to a place where like they understand these sorts of things. Like, you never know. Like, life's crazy, man. Like, I'm sure everybody saw happen in Texas, with that whole 100-car pileup. And man, I watched the video, with the tractor trailer just coming behind and destroying those cars. And I'm just like, what if that was me? What if that was me on the freeway? Is the team like mentally prepared, financially, and like to like, what if I just wasn't here? You know what I mean? So as somebody that like runs, a company, and what I'm finding is like, you have to always get people in a place where nobody is too big for the company. Nobody is too big for the project. and
Wow.
things can thrive after, and Apple's a great example. Like, a lot of people wrote that company off when Steve Jobs passed on, right? And was like,
Yes.
and it was just like, oh, it's the end of Apple. And it's like they've continued to thrive better and better, because what Steve Jobs learned was he needed to put a team in place that was, high level, and, because he didn't build a great team the first time. So he's like, the second time I get a chance at this, I'm going to build a great team. He built it, and that company's going to way outlast, his legacy and things like that. And I think that's when you really truly build a great company. It can't just be around one person, or you didn't build a good organization. So.
That's a good point, man. I mean, there's a great book called Built to Last, and it sounds like that's what you're building. It's a matter of having the right people on the school buses. What the author talks about. You gotta
Yeah.
know where the bus is heading, but you gotta have the right people on the bus.
100%, man. That's what it's all about. Yeah, I found like people is everything, and the crazy thing is, like, people look at like YouTubers and like, oh, they make a lot of money. I don't think the thing that I don't think YouTubers get enough credit for is actually the connections you can build off of a big social media following, whether it be YouTube or other things, because I have access to talent that these people would never ever consider working with me if it wasn't for the YouTube channel. I'll be completely honest.
Yeah.
Like, just some multimillionaire, who cares? But when you have a brand and people connect to that brand and you've helped them and things like that, like, people are willing to go way out of their way. Like, it was crazy. Like, we put out like a job posting, Graham and I did, for something around app development, right? And we had, I think it was over 500 applicants. And I mean,
oh my God.
And we're talking people from Google, people from Facebook, people from like big, huge companies that are willing to drop their whole life and like come on this whatever we're trying to work on. They don't even know details. Of, like, I'm there. You know what? That never happens without the brand connection with people, and the fact that you've helped people, and people like your content, people like you, and that's the biggest thing I found. Is I'm just like, wow, the access to talent when you actually have a name out there is ridiculous. So every day I'm blessed and I'm thankful. I'm like, look at some of the team members we have and stuff like that. I'm like, dude, these people, no disrespect, but I'm like, they wouldn't talk to me. They wouldn't be interested if it wasn't for who I am. It's just facts, man. It's crazy.
That's fascinating, man. Well, this has been such an amazing talk. Anything you want to wrap up on? Any final thoughts you have? First of all, thank you so much for your time. Like, I just realized we're at 2 hours and 11 minutes. Like, thank you. It's been so fascinating. Any final thoughts you have?
Yeah. So first off, I appreciate you having me on here. As far as final thoughts, I would say, if people are watching this that are not investing in anything, and even if you have a smaller amount of money, learn. Like, now's the time to learn. Like, get involved as far as learning. Like, just sometimes people think like, oh, I have to have $10,000 or $100,000. Start learning. Like, start watching YouTube videos, read books, whatever you want to do. But get the ball rolling before you ever get to big money. And don't look at yourself in a situation, if you're watching this and you've got, $5,000 or less to your name, and you're like, it's not even worth me investing. Like, any amount of money is worth investing. If you're not going to take it serious when you got $1,000 to your name, how are you going to take it serious when you got 10,000 or 100,000? And how are you going to build to those levels? Like, investing can help you build to those levels. So that's the biggest thing I'll leave off with, is for those actually individuals that are thinking like, just don't have enough, or, learn. Always be willing to learn. If you don't find any good deals in the market, keep looking. There's something out there, man.
Keep looking. I love that. People are demanding that in your outro here, where I want you to tell people how to follow you too and how to get in touch with you, people are demanding that you also pronounce your last name for us.
Oh, so I say it's Lefebvre. Others would say it's Lefebvre, but I say it's Lefebvre just for easy sake, because Lefebvre, not everybody likes to say that, so I just say Lefebvre. But then it sounds like it's Lafave. But yeah, Lefebvre. That's how it's actually pronounced. So
thank you. How do people get in touch with you?
So yeah, you can follow me on YouTube, Financial Education. Just type that in YouTube, it'll come up. Or Instagram, Financial Education Jeremy. I'm pretty active with the Instagram stories. Or Clubhouse. Just type in Jeremy Lefebvre in a Clubhouse if you want to follow me on there, because I might actually take that platform serious, man. And yeah, I don't really usually do that, so I appreciate that.
That's awesome. Jeremy, thank you so much for being on. We'll have to do this again sometime. Super fun. We'll see how the next 6 months go. Maybe in the summer, if we've got we get some drama, we'll do this again. And I appreciate you. Thank you again.
Absolutely. I would love to. Kevin, thank you. And thanks for all Kevin's people and any subscribers that came over. I appreciate you guys. Have a great day. Much love and peace.
Awesome. If you've enjoyed watching this, make sure to subscribe and share the. Thank you so very much for being here, and we'll see you in the next one.